I think the inaugural speech was essentially an advertisement for investing in America.
U.S. is at the epicenter of all discussions.
The U.S. labor market has been the most resilient labor market in the world.
I don't see a lot of merit in drill, baby, drill. I see a lot of merit in build, baby, build.
I think we're going to ultimately have to see what the year brings because there's still more unknowns than knowns in the equation at this point.
This is Bloomberg Surveillance, live from Davos, with Jonathan Ferro and Lisa Abramowitz.
Live from Davos, Switzerland this morning. Good morning for our audience worldwide. It's day 3 in Davos, Switzerland at the World Economic Forum. Once again, equity futures doing okay. Over in Europe, all-time highs on the Stock 600, which is quite remarkable given the diplomacy we're seeing coming out of Washington, D.C. Europe could be getting some tariffs. China might be getting 10%. Lisa, this changes from one day to the next.
The rhetoric, though, has softened. At least that is the perception. And right now, people are looking for areas that aren't overbid. That is why you are hearing an increasing number of corporate executives, of bankers saying there is renewed interest in Europe just because the bar is so low for success.
It's go time. Mary Erdos, JPMorgan Asset Management and Wealth Management. What did we hear from Brian Moynihan of Bank of America yesterday? There's some optimism out there. There's tons of optimism here in Davos, Switzerland, but we need to be really specific as we were yesterday. There's tons of optimism from American executives. From everybody else, Lisa, there's still a big question mark.
There's still a big question mark for everyone here, and that is to be clear. In public conversations, there's a lot of optimism. There's a bit more skepticism in private conversations about tariffs, exactly how they will be implemented and which regions are going to be affected most. And then, honestly, just about interest rates and the debt and sort of a question, an existential question about whether we are entering a new, more inflationary time and how much that could potentially stymie some of the optimism. But on the surface, Happy Valley.
Anne-Marie is not happy. She doesn't sleep anymore. She lives in Washington, D.C. She's moved. She's never coming back. Anne-Marie stuck in the nation's capital following every single headline that comes from the president, Donald Trump. Anne-Marie, another news conference. I think we've heard more from this president in 2 days, speaking to reporters, than we heard from Joe Biden in the last year.
Well, it's certainly close, given the fact that this president held a off-the-cuff news conference on his first day of office behind the Resolute desk. And then yesterday, when he was announcing this AI initiative flanked by some executives, including Sam Altman, he then started riffing once again with the press, taking questions. And that's where we heard more about tariffs. And this is what is keeping financial markets and investors on edge. Day 1 of the office, he went after Mexico and Canada. Day 2, he was back talking about China. Take a listen.
We're talking about a tariff of 10% on China. Other countries are big abusers also. You know, it's not just China. China's an abuser, but the European Union is very, very bad to us.
So tomorrow you may hear more about the European Union when Donald Trump is set to address the World Economic Forum that's taking place where you guys are in Davos, Switzerland. When it comes to China, though, what's so interesting is Donald Trump talked about 60% tariffs on the campaign trail. So potentially this isn't tariff man back. Potentially this is Donald Trump, the negotiator, the deal man is back. He's talking about now 10%. One thing we do know, there has been no executive order on tariffs specifically. There's just been an executive order on making sure there's a review on unfair trade practices. Basically, Donald Trump is putting in place the pretext for him to go after some of these countries with that review. Now, day 1, he said February 1st, but in the text, it's April 1st. So I guess the next few weeks is going to be quite volatile.
It could be very volatile, as we have seen in foreign exchange over the past 2 days. Anne-Marie, appreciate your time. We'll catch up with AMH in about 30 minutes' time. Just to confirm, she is coming back. She will be back in New York next week, I believe. But there's going to be plenty of visits to Washington, D.C.
And we'll be back in New York, too. And I do think it's interesting that Donald Trump is going to be speaking to Happy Valley, where a lot of people are paying attention to him. He's giving them some love, maybe.
I'm not sure how happy Happy Valley will be after that address. Joining us now, a happy man, Daniel Pinto, JPMorgan Chase president. Daniel, it's good to see you, sir.
Thank you for inviting me. It's great to be here.
Do you feel happy? Do you feel lighter now you know you're stepping down and retiring?
I do a bit. I've been in the company for more than 40 years. I add my contribution to the success of the company. The company is in an amazing place at the moment, and it's the right time to embrace the next generation, to work with Jamie and prepare the company for the future and his succession. So I feel good about the opportunities this company gave me, my contribution, and looking forward to a better balanced life going forward.
You are living the life that we all aspire to. Why now? And what do you expect the next 12 to 18 months to look like?
So it's very simple. This is being planned for a long period of time. And now is the time for me to transition in a very, very smooth way. This transition will go over a couple of years. My job will be to help the management team to continue advising Jamie and the board in issues that are strategic and important for JPMorgan and for the future of the company. So it is the right time. It is the right group that I helped Jamie to build up to. So I think that I feel good about where the company is and where I am now.
You've been at JPMorgan and its affiliate banks for 4 decades.
Yes.
It's a long time. You've been to a lot of Davoses. You've seen a lot of different cycles of enthusiasm. How enthusiastic is the optimism around the deal making and some of the mergers and acquisitions that could come down the pike?
I think that is quite enthusiastic. 24 was a very good year too. So you think about the M&A, the historical average of volume is around 4 trillion a year. In 2023, it was around 3.2, last year 3.5. We think that this year could get to around 4 trillion, which is historical average. And most important, we hope that the timing, particularly in the US, to approve transactions is not as long. It's moved from 6 months in the past to around 18 months. Hopefully we could go back. It's not just to announce new deals, also to close new deals. And the environment is set for that.
Well, let's talk about the environment. Is it just the regulatory shift that we need, or do you find that 4%, 5% interest rates have held people back as well?
I think that if you think about the U.S. economy, it has grown very well in 24, over 3%. It's likely to grow over 2% this year. So the environment is good. I think that even that is an economy that you don't see imbalances that tell you that it's an economy that is about to go into recession. This cycle could continue for a period of time. There is plenty of monetization that needs to be done in the sponsor space. There is essentially the valuations in the U.S. that are much higher than any other places. It's also incentivizing merging into U.S. companies. So I think that it will be a good environment.
We spoke to one banker yesterday who suggested that maybe these US companies could go on a bit of a shopping spree in places like Europe where valuations were depressed. Are you engaged in any active conversations right now in companies looking to do those kind of things? So
we are always engaged with clients all over the world, and there is a lot of optimism everywhere about what the US could do. So therefore, yes, there is dialogue everywhere.
So everyone sounds very optimistic, and then you go to some of these soirees in the evening, and people say there's a lot of enthusiasm. What actually will get done? We're less clear on, just simply because there is that question mark, to John's point, about benchmark rates, about the fact that the economy isn't slowing down so much. So why would they go any lower? And what happens if they go higher still because of debt and deficit?
I tell you how I think about it. When you think about the U.S. economy, it's in a good place. There are no imbalances. Consumer is in a good place. The corporate sector is in a good place. Inflation hasn't yet got to the levels that it should be, and the deficit is high. And then you have policies coming from immigration policies, tariffs, fiscal policies, and others. So at the end, this government is about growth. So therefore, I hope they will balance the implementation of those policies in a way that it doesn't either overheat the economy or triggers a recession. So I think that the hope is because of that, because the economy is in a good place, and certain things like rational regulation, I don't like to talk about deregulation, rational regulation in our sector, in any other sector, could be good for growth. But if things go too far, then the Fed may have to hike rates and deal with inflation. Hopefully it doesn't happen.
I guess that what I'm getting at, some people are asking, what could potentially derail this optimism? Is there anything that you could see derailing this optimism this year at a time when people are basically counting on this sort of rational regulation or some of the other pro-growth measures?
To an extent is what I said, like inflation could be. That economy goes a bit too fast and doesn't allow inflation to come down. The geopolitical space is still in a challenging place, though there is some signs of potential improvement there. And at the end is like any other policy. You can do the right amount, you can do too much or too little. Hopefully the right amount is done in a way that doesn't derail an economy that is not ready for a recession. It's an economy that is ready to continue to grow at a decent pace.
Daniel, a lot's changed in your banking career. A tremendous amount. And now a bunch of alternative asset managers are looking for the activity that traditionally was on a bank balance sheet. Can you walk us through, as you depart, how different banking might look in the years ahead compared to when you first started?
Well, it's very different. I think that is in a better place with more scale, better quality of services, a better quality of products, and a safer industry that probably has ever been. I think that if you are referring to private credit, I think that banks, we've been lending for 200 years, and private credit is no more than a normal loan. So I think that we feel very good and where we are in order to compete in that space. And at the end, so what is our objective? To be able to provide the best possible service to a client. So therefore, what is it? Is in a certain transaction, you will be able to offer a syndicated facility, or you will be able to offer a direct lending facility. Both markets will tend to converge some way or the other, and we are in an amazing position to compete because we do have relationship with all those clients, and we offer to them not just the loan, we offer to them a bunch of activities.
We saw a relationship develop between Mark Rowan's Apollo and Jane Fraser's Citi, announced at the end of last year. Are you exploring similar partnerships?
We have plenty of partnerships, several, where we have co-lending facilities with other asset managers and that they want to participate in the origination. The issue for all these funds at the moment is that they are getting a huge amount of inflows and there may not be enough assets to deploy. So therefore, to have a partnership with someone like us or Citi or any other to be able to participate in the origination of these banks is a good thing. We are doing the same, not just with one, with as many as we can.
That kind of dynamic gets people worried. Not to be negative Nelly here, but, you know, I'm going to the worries. But going forward,
Daniel's familiar with that.
I realize that I'm sounding pretty negative, but I'm wondering, given how much the flows have come in to the private credit sphere and how they've been searching for ways to be deployed, is there anything that makes you nervous within this ecosystem that's grown up very quickly?
At the moment, no. I think that when you look at these funds, they don't have too much leverage. They are leveraged 1.5 times. So from that point of view, particularly in the bigger space, bigger loans, not so much. The only thing that made me pause and think about it is there is a lot of direct lending going into small business. There is a lot of direct lending going into the smaller side of middle market. And this industry in the current form hasn't been tested through a downturn cycle. Because when COVID happened, it was all subsidized by the different governments. So how these funds are going to behave in a downturn with small business is something that you want to be concerned about it, you want to keep an eye on. But I don't think that there is a systemic issue in this space in the short term. The components are not there for that to happen.
Daniel, final question. How's the golf game?
It's okay.
What are we dancing?
It's been deteriorating and hopefully will improve.
What's the handicap now?
He has gone from 5 to 8. 5 to 8. Hopefully, I go back
to 5. Get it back down. You've got some time to do it now. Daniel, appreciate your time, sir.
No,
and congratulations on a fantastic career.
Thank you very much.
Thank you. And looking forward to covering the next 12 months with you too.
Absolutely.
Thank you, sir. It's Daniel Pinto there, the president of JPMorgan Chase. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. President Donald Trump says that he is likely to impose sanctions on Russia if Vladimir Putin doesn't come to the table to negotiate on Ukraine. On Monday, Putin said that Russia was ready for talks with the U.S., emphasizing the need for a long-term peace plan based on respect for all nations' interests. Trump said during his campaign that he could end the conflict in one day once back in office. Netflix shares are soaring in the pre-market session, more than 15.5%. The streaming giant added 18.9 million subscribers in the fourth quarter. That's easily its biggest quarterly subscriber gain in its history. That was thanks in part to live sports and the return of Squid Game. Netflix also announced that it's raising the price for its popular U.S. plan by $2.50 for a total of $17.99 a month. It's also increasing the cost of its cheaper ad-supported plan. On the other side of things, Apple has lost its crown as the world's most valuable company after closing at its lowest price since November yesterday. That drop erased more than $110 billion of market value, sending it below that of chip giant Nvidia. Apple was hit by 2 broker downgrades as well, pointing to weak sales in China and tepid consumer interest in its smartphone AI. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. I'm next on the program, cutting the red tape.
Our medium, small-sized businesses, their biggest complaint last time I was here, and we talked to the administration about it, was the biggest complaint was, you're in my pocket, you're slowing me down, I can't get things done.
Stocks are doing pretty well. Stateside equity futures up by 0.5% on the S&P 500. Even better in Europe on the Stock 600. All-time highs, Lisa, a little bit earlier in the session, which is amazing, given some of the headlines we saw overnight.
Yeah, although less amazing when you hear all of the conversations that we've been having here about people looking potentially to Europe for an opportunity at a time where essentially if it's cheap, it's better simply because people are worried about overvaluation.
Under surveillance this morning, cutting the red tape.
Our medium, small-sized businesses, their biggest complaint last time I was here, and we talked to the administration about it, was the biggest complaint was, you're in my pocket, you're slowing me down, I can't get things done, I want a permit to do something, it takes forever, I want your labor rules, all this stuff was going on just over and over. And small, medium-sized business don't have the thousands of people that big companies had to figure it all out. Over the last, say, 6-8 months or so, that it went from regulation and inflation. Inflation's kind of come down as their worry right now. And what's actually interesting is they're going back to labor shortages.
There is a really strongly held view from U.S. executives that things are about to get a whole lot better. Joining us now to discuss is the Guggenheim CIO, Ann Walsh. Ann, it's good to see you.
Good morning.
Welcome to the studio. Let's talk about it. The salespeople running around Davos trying to sell, saying things are really good in America right now and they could get even better. You've got to put money to work, and we're already priced for a lot of that. How challenging is it for you and the team?
Well, it is an interesting time. You've got rates that are range-bound. The 10-year trading between, we'll call it 375 and 475. You have credit spreads that are tight relative to history. And you have stocks that are stretched in valuation relative to expectations and at a risk premium that is less than zero. So it can be very tricky at this particular juncture. But fundamentals remain pretty strong. And so there's opportunity for investment in maybe a wide array of selections and sectors. So there's things to invest in.
I remember this sort of pendulum switching from bonds to stocks, people saying that stocks really seem like the dynamic place to be in a pro-growth administration at a time where inflation hasn't completely gone down. Do you agree with that stocks are preferable to bonds at a time where really growth is the main theme?
Well, I think that does give a lift to stocks. And as long as earnings per share projections turn out to be accurate, I think that there's still room for opportunity in equities. However, we also have to remember that not all markets are exactly the same. So if you look at the Russell 2000, you still have a very high percentage, around 40%, that are non-earners. And the Mag 7, of course, is well below risk premium levels that we've seen not since the late 1990s, where we had negative risk premiums. So I think that we have some risk associated with the market, that it is priced for perfection. So I would be cautious, but cautiously optimistic. And as long as, and we still see earnings per share rising, maybe not at the level that is priced into the S&P right now at 15% earnings per share growth, but nonetheless, still a fairly positive environment.
Stocks are priced to perfection. in your view, are bonds priced to perfection?
No, actually, I think there's some real opportunities in fixed income still. We have a risk premium that's positive relative to, certainly relative to equities. And also you're getting a real rate of return that is much better than we had pre-COVID. And you're getting a nominal rate of return in any number of areas that make a lot of sense. So we like all sorts of credit stories, structured credit, corporate credit, even high yield, and particularly the high quality portion of the high yield market. So there's still some real fundamental value that can be found in fixed income.
Can you say the same thing about treasuries?
Well, like I said, we're range-bound in treasuries, and there's a trade that's actionable there as we go up towards the top end of the range, in the high fours, if you will, 475. You can extend duration. You can then also, as we move back, shorten. After all, we saw a 120 basis point rise in the 10-year, and we were able to play that trajectory really quite nimbly, if you will, during that window of time.
The incoming government might have to look at extending duration as well. Will that complicate things? How do you think about the deficit concerns of the moment? And do you think that's been responsible for the pickup in yields we've seen through December and into the new year?
I think there's a couple things that have really influenced the rise in rates. One is the deficit, and it's a real concern. Who's going to buy all these bonds that we have to issue in the U.S.? Right now, we're still being able to be financed through both U.S. investors as well as international investors. So that story is still playing out pretty well. But at the same time, you also have a Fed that is sending mixed signals with regard to the rate trajectory. Now, our belief is that rates are still going to be moving down over the course of 2025, and we're going to move towards a neutral rate. And I think it's going to be tricky for the Fed to really find that perfect neutral rate. But at the same time, they are also still slowly reducing their balance sheet. So they're sending mixed messages, and they're also acting in mixed ways.
You know, John alluded to this idea that the U.S. has to finance all of this, and you were mentioning this, right? Where's the money going to actually come from? And we've talked about how that sucking sound of cash going into the United States to try to fuel this, crowding out some of the debt issuance and other assets in other regions. How destabilizing is it to have one economy accelerating so quickly and diverging from the rest of the world?
Well, it is unusual. But what I would also say is that because the strength of the U.S. economy has definitely been there, we continue to see an inflow of capital, and I think we're going to continue to see that. And the opportunity for investment is going to go beyond the markets necessarily and into infrastructure investment, manufacturing build-out, real estate.
For the U.S.
For the U.S.
But not for the rest of the world.
But not for the rest of the world so much. And so there's going to have to be some real balance there. But for the meantime, the U.S. is going to continue to attract capital.
Can we get you excited about Europe in any way, shape or form? We're sitting here in Switzerland.
It's beautiful.
It's beautiful. A lot of people say it's a great place for a vacation. I've always been told that by US-based investors. Can we get you excited about Europe at all?
I think that Europe has some real opportunity, but they have to really make some structural changes. And we'll see if Europe's able to do that. One of the areas of maybe concern or caution is that previously very stable governments are seeing some turmoil. France, Germany, elections coming up. And so I think that as we come through those and we see more evidence of the trajectory, and if we see a real desire for Europe to engage in structural reforms, then I think we might be able to see an investable opportunity.
There's a lot to fix, and I appreciate your time. As always, it's good to see you. Anne Walsh there, the Guggenheim CIO. It's amazing how downbeat a lot of people are on Europe, and for good reason. We could sit here and list the reasons, but we'd run out of time. And at the same time, you've got an equity market in Europe today that's at all-time highs on the Stock 600.
How many of those companies, though, that are making all-time highs are related to U.S. sales? They're actually doing better because they are hitching their line to the wagon that is the United States of America and the growth there. And that, to me, is really this big question. How much is it U.S. wrapped in European basket and looking pretty good?
Yeah, I think we got a read on that from Richmond last week, didn't we?
Yeah.
Wasn't that all just U.S.? It's picking up. It's doing better.
Remember when that was the China story? China consumer is buying everything. Now it's the wealthy U.S. consumer.
Gearing up to go on vacation this summer, no doubt, spend a lot of money, right, across the continent?
Well, speak for yourself.
With euro-dollar around 104.
Yes, I hear that, though.
Coming up, Dave McKay, the RBC CEO, to explore the tension that's emerging north of the border between Canada and the United States. That's next.
doesn't always happen that way.
Equity futures near session highs on the S&P 500. A little bit of a lift on both sides of the Atlantic through the session so far. The Stock 600 at all-time highs. The equity benchmark in the United States, in New York, the S&P 500 positive by 0.4%. Check out the Nasdaq up by 0.9%. This bond market has really settled down over the past few days. Let's get you some morning movers. We can cross over to Manus Cranny for more. Good morning, Manus.
Jonathan, good morning to you in Davos. Were you one of the 19 million people that signed up for a new Netflix account in the fourth quarter? This is what you call velocity. Not only did that beat by nearly 50%, in other words, double the estimate, but you're paying more. Price rises as well to come through at Netflix in US, Canada, Portugal, Argentina. That's what you call elasticity of pricing. Was it Squid Games? Was it Carry On? Or was it the live football on Christmas Day that drew in the crowds? And this is where Netflix is going. It's more about the live event and will you spend extra. They are going to spend $18 billion on content this year, up from $17 billion last year. That is a vacuum cleaner being switched on in terms of competition for content. Roll it over, have a look at Oracle. This is the personification not just of a deal in AI, which is called Stargate, which President Trump announced yesterday, which is a trifecta between SoftBank, Mayoshi-san, along with Larry Ellison at Oracle, and Sam Altman. But it's about access to the deal, access to power, access to being in the room. And access means everything, whether it's the AI deal or indeed being one of the protagonists that could get your hands on TikTok USA. That's what you call access to power, and $48 billion of market cap that has been added to this company in the past 24 hours. We're up 10% at one juncture. I'm rounding. United Air. This will chime for yourself and Lisa. Premium international travel. International transatlantic travel is the core component of the beat here. 20% of their revenue comes from that transatlantic lineup, Jonathan. Profits up 24% in the last year. And they're guiding for a good first quarter, 75 cents to $1.25. Jonathan.
Manus Cranny, thank you, sir. Squid Games, you watch it?
My kids did.
Did they?
Yeah.
They
I don't
like
know
that?
if that's... Yeah.
It's pretty dark, isn't it, Brammer?
Well, what do you expect?
On brand.
For my children.
I've never watched Squid Games. We'll try and work that out.
They thought the first one was better.
Okay. And this got worse?
They just
because it got darker?
No, actually, it's just a little bit more formulaic, but...
it lost the shock value?
Yeah, I guess so. Yeah, right. Thank you for
good chat.
it.
Netflix is high. Let's head over to Anne-Marie to get some more in Washington, D.C. Anne-Marie, what's happening?
Well, what's happening is that trade is really starting to become the focus in Washington, D.C. After we heard from President Donald Trump yesterday, day 2 of his administration yesterday, focusing again on tariffs when asked by reporters what really is going to be the tactic. Because remember, on the campaign trail, he said day 1, the walls are going up. What we've seen now is a little bit more of a negotiating tactic. And what we've seen from the likes of whether it's China, Canada, or Mexico, these leaders are starting to talk about what their plans are to really combat what's coming out of this White House. So we heard from Prime Minister Justin Trudeau of Canada yesterday saying that this is what Trump likes to do. He's a, quote, skilled negotiator, wants to keep you a little bit of off balance, and that what Trudeau says is that the Canadian government really has a plethora of what they can do to combat these tariffs. So if the United States comes in at something a little bit lower and not as grand, then they can also come back a tit for tat, dollar for dollar. If the United States goes to, say, 25% on Canadian imports and tariffs on that much, they're looking at potentially maybe aluminum. So we do see U.S. trading partners preparing for Trump 2.0, given the fact that we haven't got exactly what he's going to do on tariffs. We do know that he wants to have a review until April 1st. I like what the Mexican president said. She said, you know what, we all need to take a deep breath and keep our heads cool when dealing with this new administration and this new world.
We'll take a deep breath right now. Anne-Marie, appreciate it. Joining us here in Davos, Switzerland, Dave McKay, the CEO of RBC. Dave, it's good to see you.
It's great to see you here in Davos.
We can talk about Squid Games a little bit later. Let's start with this spat. I don't understand this spat. Let me be perfectly honest. I remember when you joined us a number of months ago, 34 states in the United States run a surplus with Canada. If you strip out energy, the United States runs a surplus with Canada, except America needs the energy from Canada because of the way the refiners are set up. So can you help explain to me what this tension is all about?
Yeah, no, certainly there is tension, but you go back and look at the long-term relationship we've had with the United States. To your point, the supply chain integration, the energy integration. The U.S. imports 6 billion barrels a year, 6 million barrels a year 60% of that comes from Canada. To your point, gets upgraded in the Midwest. That's significant profit. You can buy it at a 20% discount, upgrade it, make $20 billion of profit. So very strong alliance there. Therefore, there's a lot of signaling going on, I think, in the communication, signaling the importance of energy, signaling the importance of defense and borders, signaling the importance of the Arctic. So, within that messaging is a very strong communication that there's more we can do together. There's more energy we can produce, particularly LNG. Asia needs LNG. America's partners in Asia need LNG. We have multiple pipelines that we can export to Asia. We've been able to build those pipelines and export LNG. We can build a stronger alliance with America by leveraging our resources, not just fossil fuels, but rare earth minerals. I mean, germanium, gallium, helium. I thought germanium was a flower maybe a year ago. Germanium is a critical mineral now.
A couple of reverse lives. Carry on.
When you think about the production of germanium necessary in fighter jets and military equipment, China was a supplier before, so there's opportunities to build deeper supply chain integration on rare earth minerals. 70% of our potash goes to American farmers.
Yeah.
And therefore, food security and food defense. You look at uranium needed for nuclear power to drive all of those, all that power needs from an AI strategy. 30% of uranium into the United States comes from Canada. So when you look at the opportunity to develop and export, it's completely in sync with the president's strategy.
Do you think Canada has failed to communicate that message over the last several years?
We failed to develop our resources in an expedited manner. And therefore, the message is very strong to Canada. You have these assets. They're an important part of the overall relationship. You need to change your policy. You need to change your communication. You need to get the projects done. You need to get the mines developed and into the marketplace. It's absolutely required for national security issues, for future energy issues, and that's our challenge. And we accept that challenge, and we can do this, but we've got to get going on it.
One of the obstacles, though, and this has been an obstacle for a lot of places, is leadership. And we've seen the sort of collapse of the government and the sort of question around who's going to take the helm and negotiate with Donald Trump. And there's what you want to see happen, and then there's just dealing with the reality that you face now.
Right.
How much, as a bank executive, are you saying, I'm just going to expand more into the U.S. because that's where the dynamism is, and hey, it can protect me?
Yeah, you're so right. So, capital flows where there's certainty, and where there's opportunity, you can earn a return. And when there's uncertainty about the rules and regulations, it's harder to invest capital. I would say, and you're seeing this in the American exceptionalism, tone at the top matters. It matters at the top of a corporation. Tone at the top matters on national issues. When you see, you call it animal spirits in economic terms, when you have a messaging from the top in the United States around pro-business, getting things done, removing red tape, leveraging talent, that causes investment, that belief in the future opportunity. And whoever leads Canada, and we'll go through a democratic process, tone at the top, whoever gets leaded, is something I think we're missing in Canada.
Well, in the United States, as a bank executive, as you expand in the U.S., how much is the focus on something you know very well based on the Canadian economy, which is oil and gas, at the time when you've got drill, baby, drill, and an increasing amount of energy needs with artificial intelligence? Have you been focusing in particular on that area to really expand more broadly in the United States?
Yes, certainly. As we look at our markets-based business and capital markets, we've had a significant opportunity to serve clients. We're a leading energy bank, but we also focus on balancing the overall emissions in that portfolio as we've committed to an overall journey towards net zero in 2050. How we get there as a society, we're being challenged on all fronts to maintain prosperity, to maintain growth and equality. And we have to make some tough decisions as a society, how we're going to balance all of those and maintain our competitiveness. Now, we're carrying significant amounts of debt, government debt, corporate debt. And you hear the themes here at Davos. What are politicians and businesses talking about when you have these high debt loads? They're talking about growth. Growth and competitiveness is the theme. And therefore, if you want to grow and be competitive, you have to think about your rules, your regulations, attracting capital into your marketplace. Now, 40% of global capital flow went into the United States last year. To your example, to your question. Therefore, that tone, the ability to be successful, the rules, all that has really driven strong growth in the United States. And you're seeing European leaders mimic that. We got to see that mimicked in Canada as well.
Speaking of growth, AI. and the growth of infrastructure around AI. Big push overnight from the US administration. Could you potentially describe the opportunity that's available to the Canadians to explore doing something similar to what's happening in America?
Yeah, it's a great question. For AI, you need data and platforms, but you also need power. You need clean power. You need cost of power is really important. If you look at the differentiation, the struggles of some of the countries around building secure power, it's the cost of power has made them uncompetitive. And you look at Germany. So what Canada has to offer, to your question, when you have such large power needs to store that data and to process that data, you need a colder climate to keep the servers cool. You need abundant and cheap electricity. And therefore, when you look at Canada's ability from not only hydroelectric, but from gas-powered energy, and then in the future, more nuclear energy, it's a great place to put your data. It's better to move the bits and bytes than it is to move the natural gas and pipelines, and therefore a huge opportunity for Canada to provide cheap, green energy to power those data centers. So we want to be part of that, and we're pitching that, and you're seeing a lot of interest in Canada from U.S. platforms in data centers. So it's a great question.
I feel this tension between increasing energy abilities, energy production, and reducing emissions, having sort of some kind of clean goal. And it's really been a vibe shift that we've seen pretty dramatically. RBC is now the only large Canadian bank that has not exited the net zero banking alliance. Are you expecting that to change?
Yeah, so as I've communicated before, we have a process that we're going through to evaluate that. I think the NZBA served a purpose early on in its incarnation to get banks together to talk about their journey, created a scenario that's becoming increasingly improbable in the world of a 1.5 degree, and therefore as we think about how we take this journey, so is it served a purpose going forward? I'm not sure the NZBA, as the Canadian and the US banks are signaling, kind of served its purpose already. Stay tuned. We're going through kind of an overall review process, and we'll make that announcement in due course.
Just to find a few questions. Have you spoken to the Conservative leader, Poilievre?
I have, yes. Yep.
What's he like? What are you hearing?
No, he's got a lot of experience in our country. He, has a hunger to lead the country, obviously, as he's expressed that, and he will go through an election process likely this year to convince Canadians that he is the right person to lead us. And I just come back to my original message. Tone at the top, so important. You've seen that in the US. You're seeing a change in the tone at the top in Europe. Pro-business, pro-growth, less regulation. We got to get things done. So whoever leads Canada, whether it's he or someone else, we just need that leadership.
Dave, it's good to see you. As always, great to catch up. We'll see you back in New York soon, no doubt.
Absolutely.
Thank you, sir. Dave McKay there, the RBC CEO. With an update on stories elsewhere this morning, let's cross over to New York and catch up with Danny Berger for your Bloomberg Brief. Hey, Danny.
Hey, John. President Trump says that he is open to Oracle chairman Larry Ellison or Elon Musk purchasing TikTok as part of a joint venture with the U.S. government. Trump signed an executive order on his first day in office, extending TikTok's sale deadline by 75 days. Billionaire Frank McCourt and Shark Tank investor Kevin O'Leary made a formal offer to buy TikTok earlier this month. Shares of United are rising in the pre-market more than 3.5%. United reported fourth quarter earnings that beat estimates and projected first quarter profit well ahead of Wall Street expectations. The airline attributed the strong outlook to an unusually high demand for premium and international travel. Meta is working on upgrades to its smart glasses and exploring new wearable devices like watches and camera-equipped earbuds. People familiar say that Meta is working with Oakley to create smart glasses for athletes this year. Meta aims to release its first true augmented reality product around 2027. And that's your brief, John.
Danny, thank you. Flew over here with United, so let's talk about United. Okay, just briefly. Everyone seems to have global services and Premier 1K. So I'm standing there and they're like, can we have global services? That's like their concierge key, their top tier. Half the plane goes on. Then it's Premier 1K. It's like the other quarter of the plane goes on.
So what did Mohammed have to pay you in order to go on United?
To go on United?
Yeah, exactly.
I've got thoughts. I'm not sure if I should share them. I shared them with Mohammed.
I'm sure you did.
I'll tell you.
I'm sure you did.
I've got some thoughts, all right. No one wants them. Up next on the programme, US exceptionalism.
US is at the epicenter of all discussions. It's risk on. Folks want to go. There's a ton of liquidity out there. There's a lot of pent-up excitement. So let's kind of, wait and see.
Equity futures up nicely this morning on the S&P 500, elevated by a few tenths of 1%. Outperformance by the Nasdaq. We're higher there by 0.8 of 1%. Bond yields have been lower over the past few days, stable around 460. Your 10-year yield at the moment, 457.44. Under surveillance this morning, it's US exceptionalism.
U.S. is at the epicenter of all discussions. It's risk on. Folks want to go. There's a ton of liquidity out there. There's a lot of pent-up excitement. So let's kind of, wait and see. You're seeing the biggest pools of liquidity all in the United States. So you had the building blocks of, when we look at the valuation arbitrage, U.S. corporates versus even Europe and rest of the world. I mean, there's a massive differential.
We've heard this from Citigroup right there. We heard it from JPMorgan a little bit earlier this morning, about 50 minutes ago. Lisa, you're hearing it across the board.
The question is how much the optimism is going to translate into deals getting done and then a pipeline building back up, and what that pipeline looks like, where it's getting financed at a time where the market looks very different today than 5 years ago.
Let's extend some of that conversation right now. Perfect guest for it. The Nyse president, Lynn of the New York Stock Exchange. Lynn, good to see you.
Good to see you guys. Nice pad you
It's
guys
not
have
bad.
here.
It's not bad.
Like
I'm not
we did
paying
at
the
the
rent.
place?
Yeah.
I'm not paying the rent, that's for sure. Everybody's so upbeat. Can we just start there? You met with the president very recently, opening bow at the New York Stock Exchange. What was that like? What did he say?
Well, it was amazing. I think it really put a fine point on his focus on highlighting the U.S. economy and the strength of the U.S. economy. Feels as though the pro-growth agenda is going to be something that's front and center, not just for him, but for his entire cabinet.
I can feel that in the confidence levels. Are you seeing it already in the activity levels? Do we have to wait for that?
No, we're seeing it in the activity levels. We're seeing the IPO market start to open up. Although last year wasn't a bad year, particularly if you look at the first half of the year. Got quite a few deals out. And then you had a bunch of volatility set in because of the election. You weren't quite sure what the outcome was going to be. So a variety of deals pushed. Those deals are now getting on the road. They're making plans to IPO either in the coming days and weeks or at quarters or second half of the year. But the activity is real.
How much are companies waiting for some certainty? I mean, we're getting buffeted around by different headlines of different potential policies and tariffs that may or may not come. And is it a negotiating tool? I mean, it seems like people are saying things that they don't really understand or believe because they don't really have any of the facts. How much are people waiting for some of that to shake out before completing a deal?
I think people are waiting to see some deals go, quite honestly, and to do well in this environment. If I look at our IPOs from last year, though, of all of the IPOs that list on the New York Stock Exchange last year, in aggregate, they were up 58% versus their IPO price. To me, that's the sign that the market's really open. So once you remove that uncertainty around the election, now's the time to go.
I was speaking with one bank executive who said the market's been open. This is a market that has been open, but there have been a lot of companies that don't like the price that they get when they go out there, especially if they've been hiding in the private markets and have been really elevated in terms of their valuations. Is there a growing disconnect about the need for going public at a time where companies can remain private and even be highly valued as private companies?
Liquidity, though. That's the one thing that you don't get in the private markets. Consistent, sustained, and deep liquidity. Nothing beats the liquidity of the public markets. I think the private markets, make no mistake, play an incredibly important role because not only do they fuel that next great idea when it's in its infancy, but it also is able to take a company to the point where it's public market ready. What you saw were companies rushing out 5 years ago, even in 2021, when we saw the height of IPOs, they rushed out to really take advantage of those valuations, and a lot of them weren't ready to be a public company. I think as a result of what we've seen over the last 3 years, you're going to see the companies that come to market be higher quality, know how to execute on strategy, profitability, capital returns, all of the fundamentals that make public companies successful.
When you say not public market ready, what do you mean specifically by that?
Clear strategy on where you're going with your business as opposed to throwing a bunch of spaghetti against a wall with a variety of ideas. By the way, that's super important when you're a company in its infancy because you're not sure which direction you're going to take.
Do you feel like your business structurally is challenged by what's been developing in private markets? And what do you think explains the decline that we've seen in publicly listed companies?
Well, we spend a lot of time really working in partnership with the private markets. Our job is to ensure that when a company goes public, it's ready. It's able to take advantage of the depth and breadth of liquidity in the U.S. markets. So we spend a lot of time on the educational side.
How much are you seeing foreign entities looking to list in the United States at a time where there's an increasing feeling that you have a leg up if you have a more physical presence in the United States?
Yeah, we've actually executed on a variety of transitions out of domestic markets, non-U.S. markets, over to the U.S., and those companies have seen a marked valuation appreciation.
There's one country that probably is absent in that, or at least will be going forward, or could be, which is China. And I wonder how much we did see a lot of ADRs, a lot of receipts, depository receipts from Chinese companies in the United States. Do you expect that to fade, given the tensions?
You know, there have been some deals that have come to the U.S. market, but they're fewer and further between. I think as a result of economic policy and geopolitical policy between the two countries, it's still very early. Let's see how things progress in the next few months between the U.S. and China. There'll be additional clarity on that topic.
Are you confident that maybe there could be a resolution? Because the sitting president, Donald Trump, hasn't been as aggressive as some people thought he might be in his first 2 days.
I think that he is very pragmatic when it comes to considering the ramifications of geopolitical tensions.
Do you feel like people are being very careful at this particular Davos? That everyone's like, yeah, we're excited. We don't know anything, but, you know, we're excited and there's a lot of optimism. Or do you feel like people have a real concrete sense of kind of what the next year is going to look like?
I think people are optimistic in pockets. I think there is questions around, you know, the geopolitical landscape is probably the biggest one, tariffs in particular. And obviously the knock-on effect of questions around tariffs is going to be inflation, because those two really do work hand in hand. So I'd say people are pretty optimistic, though. And even on the geopolitical side, if you look at, you know, the deal that was done last week to release the hostages and the ceasefire in Israel, between Israel and Gaza, there is reason for optimism. There are green shoots that people are able to point to. There are data points.
Positive steps already so far. I think we all hope we see more. Lynn, it's good to see you.
Good to see you guys.
See you very soon. I know. Lynn Martin there, the Nyse president from the New York Stock Exchange. Lisa with an aversion to happiness and optimism.
No, hold
here in
on
Davos,
a second.
Switzerland.
No.
No?
Okay.
Okay.
No, happiness is a good thing. I actually think we need to celebrate happiness, study it actually more.
Ringing endorsement.
And actually, but I think that there is a feeling of what exactly am I missing? Because in the past, Davos messages have not necessarily been borne out. So I think it's important to question a consensus at a time when there still is a lot of uncertainty. Just being, you know,
I'm winding you up. I totally agree with you.
I know, you're winding me up.
Gary Cohn said this yesterday. Gary came on the program and he said, you have to take everything in Davos with a grain of salt. Ken Rogoff was with us, formerly of the IMF, you're all familiar with the professor, made the point that this time around, he's got doubts around whether we actually see that boom.
Well, we need a little bit more grains of salt on the sidewalk. Maybe we could get that happening.
Yeah, that's a different complaint. I'll share that complaint with you the next hour. And on the airlines, maybe. Up next, in the second hour of Bloomberg Surveillance.
Can't wait.
We'll catch up with the former US Secretary of State, John Kerry, the former Speaker of the House, Paul Ryan, the Coca-Cola COO, and the Gap Inc. CEO as well. From Davos, Switzerland, this is Bloomberg.
The Fed is not getting the economy to slow to the extent it wants.
Prospects look like they are accelerating, improving, and valuations suggest that.
I wouldn't quite say a recession's around the corner, but it's not as many miles away as it was, you know, at one time.
We are more concerned about the debt and the deficit today than we have been in a while.
I think that it's hard to really have a crystal ball about inflation right now. I think it's a much less certain picture.
This is Bloomberg Surveillance, live from Davos, with Jonathan Ferro and Lisa Abramowitz.
Shall we do this now? I know it's beautiful. But honestly,
but
it is possibly one of the worst kept ski towns in Europe. And I'm talking specifically about the sidewalks.
There's been a lot of slippage. We've seen people
all the
falling.
time.
Yes, this is true. Yes,
all
it's
the
true.
time.
We can get into that later, but we can talk about
Secretary Kerry wants to weigh in, but he's going to have to wait and all of that. You want to weigh in now?
You're unhappy.
I know. Not with you. Not with you. I'm always happy to see you. I'm happy to see you. Got to get through some stuff first. I know. Just as that, you know. difficulties. We can have a longer conversation in a moment, all right, about those things. Let's head over to Washington, D.C. There's a lot to talk about. Let's catch up with Anne-Marie. Anne-Marie, it's been another busy 24 hours and lots of changes from the incoming president.
An incredibly busy 24 hours, although I do need to weigh in. I do agree with you. They should just move it to Megève or San Moritz. That would be my preference. I'm not there this year. Good luck to you guys on those sidewalks. In Washington, D.C., it has been incredibly busy. Yesterday, we got another announcement from President Trump, flanked by tech executives like Larry Ellison and Sam Altman of OpenAI, talking about this AI initiative. And we are talking about a tremendous amount of money that the president wants to put towards this and the deregulation process he wants to see to make sure that we can have AI data centers and that America is leading the way for this. Take a listen to a little bit of what he had to say yesterday about this new initiative, which is called Stargate.
Announcing the formation of Stargate. So put that name down in your books, because I think you're going to hear a lot about it in the future. A new American company that will invest $500 billion at least in AI infrastructure in the United States and very quickly, moving very rapidly, creating over 100,000 American jobs almost immediately.
So we still need know more about the scope and some of the details when it comes to Stargate. What we do know is that chairman of SoftBank will be the one taking the lead on this, and then potentially other companies will also be working with this new joint venture, including the likes of NVIDIA, Microsoft, and ARM Holdings as well, John.
Anne-Marie, appreciate it. Now I can do a more formal introduction to the former US Secretary of State, John Kerry, also co-executive chair of Galvanized Climate Solutions. Secretary Kerry, good to see you, sir.
Glad to be here.
We'll start again. I'll be more upbeat. I'm happy to see you. You know I am.
Thank you, sir.
The new president says drill, baby, drill. I want to understand how you feel about that and what kind of trajectory you think we might be going on through the next 4 years.
Well, I think the president's correct that we need an abundance of what we call firm energy. We need to make sure that America is leading in the technologies of this transition to new energy, clean energy. But I would say that build, baby, build is, drill, baby, drill ought to be replaced by build, baby, build, because that's what we need to do in all aspects of energy. There will be higher demand. He's absolutely correct. And I'm glad to see a $500 billion infrastructure announced, because that's going to be the key to our doing it. And it's going to be the key to leading in AI. But, and there's a huge but, data centers demand a massive amount of energy. And that's going to become very competitive. Will that energy be provided by clean energy, or is it going to just add to the problem we have of a warming planet with increased intensity to our storms, more damage all around the world? We haven't suddenly lost the connection between the choices we make about how we provide energy and its impact just because we elected a new president. So we've got to stay tuned into the science. We have to stay tuned into the marketplace, and the marketplace is going to move predominantly in the direction of this new energy. To wit, last year, about almost $2 trillion went into venture capital for new energy, clean energy systems. $1 trillion went into fossil fuel. That's a 2-to-1, first time ever shift in the marketplace. And if you look at what's happening in that marketplace, other technologies are coming online. Wind, Texas, the home of fossil fuels in America, that is now the leading state for the deployment of wind turbines. So I think the marketplace is going to continue to invest and move in this direction on a global basis.
Is that the marketplace or government intervention?
No, that's the marketplace. It's happening all around the world. I mean, I've been recently in the Far East, in Singapore, and recently also in the Middle East, in most of the Middle Eastern countries. Everyone is engaged in this transition. UAE, a major producer of oil and gas, is also a major producer of new nuclear plants. They've got 4 new nuclear plants. They have a vast array of solar, one of the largest fields in the world, and they are determined to have a higher level of energy produced by renewable energy.
But to build on what John is talking about, I'm thinking about, let's say, the electric vehicle credits. And there was this idea that we would really transition people to vehicles that were considered cleaner. And yet China did it successfully because they have the resources to do that. The United States doesn't. They need to import them, and it actually makes the U.S. more dependent on other places. Were some of the government policies misguided in what was necessary to actually tackle the problem from an economic perspective? I
think we worked very hard to open up new supply chains, and we did open up new supply chains. India is an example. We invested about $500 million in trying to build, in building the largest production plant in the world. And yes, China has, in fact, captured much of that market. And they captured it, frankly, with unfair trade practices, which is one of the reasons that's a legitimate issue between us and them. And we have to work that out. Solar was really worked on and developed by the United States and Germany. And then China stepped in. There was a massive amount of dumping into our country, and the production gravitated towards China. But today, China is now, many people complain, including the president. The president said China is not doing what it should be doing. Well, China is the largest producer of oil, of renewable energy, and deployer of renewable energy anywhere in the world, including more than all the rest of the world put together. So China is now commanding the market just by virtue of its production level. We need to get into that and compete.
But it raises this question: national security versus cleaner energy. It kind of pits two of your babies together. It sort of raises this question: which do you prioritize?
The climate crisis is a national security crisis. The fact is there are about 39 million people wandering around Africa, elsewhere, trying to knock on the door of places where they think they can live, because they can't live there anymore. They can't produce the food anymore. It's getting too hot. You can't work outdoors. So that's going to increase. That challenge, we had about 1 million people come in from the desert into Damascus, which changed the dynamic of the Arab Spring and of the war in Syria. So there's a linkage. What happens when water starts being reduced in its spread? What happens when the food basket of Africa implodes because they can't grow it anymore? These are real threats that smart people are spending a lot of time analyzing and understanding. And within the Pentagon, the Pentagon has called the climate crisis a threat multiplier. It presents serious challenges to all of us, and we need to treat it like the security issue that it really is.
But you understand, to Lisa's point, that we have become more dependent on an adversary, on China, for all the reasons that you described. And yet we have some of these critical minerals, these resources within the United States. I'm sure you're familiar with the Resolution copper deposit that Rio's explored. It's ready to go, can support 25% of the copper demands of the United States of America, and yet for some reason it's been dragging along and hasn't been greenlit in the way that it should be. Why haven't we done that?
We have a problem in the United States, which I hope will be cured. It's a bipartisan challenge. We need Republicans and Democrats alike to come together in order to do permitting reform. We have 2,000 gigawatts, a huge amount of energy, almost as much as China has today. We have that backed up at FERC, the Federal Energy Regulatory Commission. That has not been approved over these years. Why? Politics. And so I hope we're going to get the politics out of the way, and I think President Trump understands that. That is a way to accelerate the deployment of the energy that he has now said we need.
Why do you think that didn't happen under a Democratic president with a Democratic Congress?
Politics. Why didn't the immigration bill...
Democratic politics.
Why didn't the immigration bill that had been put together with, Senator Langford from Oklahoma, he worked hard at that. It was bipartisan. It was ready to be passed. And President Trump, then former President Trump, called up and said, don't pass this. It'll help the Democrats. It'll help the Biden administration look good.
Do you think the Democrats helped themselves?
Look, I'm not here
You started this conversation. Do you think they helped themselves over the last 4 years? The Democrats, over the last 4 years. Did the party help themselves?
I think there were serious questions about the message and so forth, but I'm not here to be political. I'm here to talk about the energy crisis.
Isn't there something very political about this crisis, though? It is by its very nature political.
It seems to have been weaponized. And unfortunately, that's a loss for all Americans. For instance, if you decide, as President has, to pull out of Paris, we are not at the table. We lose the leverage of being at the table. We lose the protection of our country in terms of something that might be passed or not passed by not being at the table. Moreover, last time he pulled out, there was only one person in the entire world, of all the leaders in the world, that pulled out of the Paris Agreement. And by the way, the Paris Agreement was still implemented in the United States because we have 37 governors who implement renewable portfolio laws, and they did that. We had over 1,000 mayors join into something called the We're Still In movement, and that's exactly what's going to happen now. And by the way, and this Bloomberg obviously understands better than anybody, the power of the marketplace is what is going to make determinations here. Oil is a commodity and hasn't really changed much in price for over 100 years. But technology is what is really driving these changes that are taking place. And I think rather than being driven by commodity prices, this revolution is going to be driven by technology prices, which are now lower than the prices of fossil fuel.
You've been a big proponent of not exceeding this 1.5 degree increase in the global climate. You've said that you think we're going to blow past it. You're working with Tom Steyer of Galvanize to try to raise money. There's been a huge vibe shift away from ESG where people are saying, well, if we can't solve it, whatever. Yeah. How do you sort of see the enthusiasm to invest in things that have been highly politicized, that have been weaponized?
That is a great question, and I'm really glad you asked it because it's central to what we're doing. Nothing that we're doing is based on reliance on the government to do something or reliance on a subsidy of some kind. We're not in there to find or to be the source of concessionary funding or to find the concessionary funding. We are investing in portfolio companies that have the ability to affect this transition just on basic fundamentals of business, just looking at the marketplace. And we will show people how, in fact, and there are other companies doing this now, how this transition will allow you to invest and make money. And you will be able to make better returns than some other things that are out there today. That's the basis of this investing. And when the market sees the way that a whole bunch of people are, in fact, turning this around, making money, AI is going to be a big part of this. Geothermal may be a part of it. But you need an all-of-the-above investment effort now because the science is telling us we have to move faster. And ultimately, that demand is going to change people's attitude about this. Electric vehicles grew by 5-fold last year in sales. Solar grew by about 4-fold last year. Solar has now had a 60% reduction in price. So whereas oil is affected by the economy as a commodity, the renewable portfolios are going to be affected by the technology change, which is lowering their costs. Yeah. And I'll tell you what, right now, there is no question but that the reduction in price of wind and solar and the new fibers that's available to transmit higher levels of energy at much lower cost, all of these things are coming together to say it is cheaper. 1.7 cents per kilowatt hour in some contracts that are being let now on solar. So I think the marketplace is going to make this decision, and no one person.
You'll forgive me for jumping in because we're up against the clock, sir, but I just wanted to fit in one final question because your voice is important on this issue. Are you encouraged by recent developments in the Middle East and the agreement struck between Hamas and Israel?
Well, obviously, I think it's great that we've got an agreement that a lot of people worked extremely hard on for some period of time. Things are always tentative and difficult in that part of the world. A lot will depend on the government of Israel and how it approaches the future. I saw a debate this morning on TV about the meaning of the West Bank, and if efforts are made, I think, to move to the sort of greater Judea-Samaria philosophy without resolving what's going to happen in the long-term governance, is going to be a real problem. So hopefully wiser heads will prevail and people will move forward. But you have to begin to build building blocks. This is the first step. Yep. Build a little confidence. Make some things happen. But then hopefully have a shared vision for the long-term future of Gaza and of the West Bank, and obviously for Israel's security, which is paramount. You've got to be able to resolve that as you move forward.
I think we all share that hope. Thanks for being with us, sir. Appreciate your time, as always.
Glad to be here with you. Thank
John
you.
Kerry there, the former US Secretary of State. Let's give you a quick update on stories elsewhere with your Bloomberg Brief. Here's Anne-Marie. Hey, Anne-Marie.
Hey, John. Here in Washington, President Trump is widening his tariff threats to now include China and the European Union. On his second day in office, Trump vowed to hit the EU with tariffs and said his administration is discussing a 10% duty on Chinese imports. China's Ministry of Foreign Affairs spokeswoman said that there are no winners in a trade war, adding China would safeguard its national interests. These threats come a day after Trump threatened to impose tariffs on Canada and Mexico. Fire crews are continuing to battle the ongoing blazes in and around Los Angeles, with the Palisades fire reaching 65% containment. Elsewhere, there's been encouraging progress with the Eaton fire now nearly 90% contained, with evacuation orders lifted for portions of Adena. Still, more than 10 million people remain under red flag warnings through Thursday amid gusty winds and ongoing extremely dry air conditions. Locals are hopeful that the first rainfall of the year is coming this weekend. And Johnson & Johnson shares are a little changed in pre-market trading after the pharma giant's fourth quarter earnings topped estimates. Sales of its cancer drug, Darzalex, surpassed $3 billion, marking a more than 20% increase from a year ago and offsetting declining demands from other products. The company is continuing to invest in new medicines, including its recent $15 billion acquisition of intracellular therapies, and is optimistic about the industry's future under the Trump administration. A lot more news from Washington. John, back to you.
Anne-Marie, thank you. Up next on the programme, we'll catch up with the former Speaker of the House, Paul Ryan. That's just around the corner. From Davos, this is Bloomberg. Live from Davos, Switzerland, at the World Economic Forum for our audience worldwide. Equity futures right now positive on the S&P 500 by close to 0.5%. Lots of changes overnight on the trade front once again. Lots of threats that we can explore with the former US House Speaker, Paul Ryan. Speaker Ryan, it's good to see you, sir.
Hey, good to be with you.
Let's think about the ideology of the sitting president. What is the ideology? What's your familiarity with the ideology around things like trade?
I think the best way to describe it is America first. I think he's articulated an America first. On trade, it's a little more mercantilistic, say, than the traditional Republican, Reagan free trade. But America first is the quickest way of describing it. A lot of good fiscal policy, regulatory policy, tax policy. There's a lot of optimism, frankly. But on trade, I'm sure you have an international audience here. There's going to be some trade friction, no two ways about it.
Without a doubt. How do you feel about the mercantilists taking over the Republican Party? Was that the right step?
Well, there's different kinds of Republicans. I'm a classical liberal, free market, free trade Republican. So I'm a different breed of a Republican. His breed of populist Trump Republican is the ascendant breed. They're basically the dominant force in the Republican Party. Donald Trump is the dominant force of the Republican Party, no two ways about it. But we have a coalition that is playing nice with each other right now. And frankly, I'm optimistic on a lot of policies that are coming together. And all of those policies will not happen if you have Republican disunity. So I think it's very important that Republicans stay unified. The executive branch has an enormous amount of power when it comes to trade policy. That's something that 100 years ago Congress ceded to the White House. But on all this other fiscal policy, Congress has a huge role to play. And it's really important that Republicans stay unified with these razor-thin majorities we have.
One of the initiatives that they need to deal with is the deficit. And I'm focused very much on the bond markets. And I'm sure you are, too, as a free market Republican. And I just wonder how much conviction you really see in both camps of the Republican Party, as you just laid out, to truly combat some of the deficit concerns that we feel here at Davos.
There are definitely deficit hawks in Congress, no two ways about it. The people running the various committees in charge of this, the Budget Committee, the Ways and Means Committee, the Finance Committee, they are deficit hawks. So, first of all, you can't do well on your debt servicing if you don't have nominal GDP growth outpacing your debt servicing costs. So, number one, fast economic growth is paramount. That's why this deregulation is very necessary. That's why extending tax reform is necessary. We don't want to hit the economy with a wet blanket like Biden did with the promise of higher taxes and more regulations. Really important. On the debt, the only way to get the debt under control is to do entitlement reform. That's more of a comprehensive thing. That's what I spent most of my time in Congress working on. I think there's a way to do it. There's a the most bipartisan solution that's out there right now are these fiscal commissions. There's a lot of talk about that. It wouldn't surprise me if Congress acted in a bipartisan way on a fiscal commission, not like Will Simpson, which I served on, but one with teeth that requires action. That's probably the biggest talk in town right now about real debt reduction. But in reconciliation, who knows? You could see some debt reduction occur there, too.
We've already heard, though, from this administration. They're not going to cut Social Security. They're not going to cut Medicare. They're not going to cut any of those entitlements that they really want to cut. And I just wonder.
Well, I wouldn't say they really want to cut.
Well, I'm just
that's
saying,
not the way to
okay.
say it. Everybody who ran for president lately has been saying we're not touching these things. I don't agree with that. I'm a different, like I said, a different breed of Republican.
Do you think that it's going to hit the wall, that there's going to be a real challenge that undermines some of the optimism that we're hearing here?
Well, within a decade, you have both the Medicare Part A trust fund and the Social Security trust fund going bankrupt and insolvent. So you have to do something about that. You've got to step in front of that. By the way, you don't need to cut these programs to fix this. You can grow them a little more slowly. You can reform these programs. And you can do it on a prospective way so that you don't affect people in or near retirement, but do it for the younger generation, like my ex generation. So there are good reforms out there that I think are politically palatable, that move the needle on the debt tremendously. The question is whether or not, and by the way, if it were easy, we would have already done it. I passed 4 budgets in the House when I was budget chair that did this, but they met nowhere in the Senate. So this is really hard to do.
Would you vote for an extension of the Tax Cuts and Jobs Act?
Absolutely.
Why does that make sense?
Because we want growth. If you don't do this, the kind of tax increases that are going to hit the economy, first of all, immediate expensing, R&D amortization, these are very important business tax relief. But what people who aren't Americans don't necessarily see is more than 2/3 of our businesses are not C corporations. They're pass-throughs, LLCs, subchapter S corporations. They pay their taxes as individuals. There's a massive tax increase on those businesses, the engine of job creation in America, if you let those things expire. So that's really important. It's this thing we call Section 199A. I don't want to get too deep in the details.
We haven't got time.
It's going to be bad for the economy if you let those tax cuts expire, so you do need to extend
Scott
those.
Bessent said the same thing. He said it could be an economic calamity. Could you describe that calamity for us? Just how bad?
I'd say about 80% of small businesses would have a massive tax increase, over 20% tax increase. And, oh, by the way, you'll put them at a massive competitive disadvantage against corporations. Huge job dislocation. And most of our jobs come from small and medium businesses. You cannot hit those with a big tax increase.
You know
so
how difficult it is to put together these bills. That's only one piece of the tax effort.
Yeah, I wrote the last one.
I know you did.
It was, and I had a 22-seat margin. Easier to play with the 22-seat margin.
They don't have those margins this time around. How difficult is it going to be to do anything above and beyond just extending?
This is why I say Republicans need to stay unified, because all of us agree on this type of fiscal policy. We may have different disagreements on trade. We don't have disagreements on this. Really important that Republican factionalism doesn't occur. They stay unified and get this done. The country's counting on us. Donald Trump promised it. And one of the reasons why people are so optimistic is because they believe this is going to happen. At Teneo, we polled 700 CEOs representing $10 trillion of wealth, and it's a 32-point swing in optimism from last year to this year.
We've seen it
on the U.S. economy.
And I can tell you, Speaker Ryan, we hear it repeatedly every single hour.
That optimism has to be translated into policy for it to be realized, and that means pass this bill.
Speaker Ryan, thank you, sir.
You bet.
A not-so-warm welcome from Davos, Switzerland, to the World Economic Forum. To those of you waking up stateside, freezing, I hear, on the East Coast, so good morning to you all and stay warm. I'll bring you a brief market check for you with equity futures right now on the S&P 500 up by 0.5%. Nice rally on the Nasdaq today. Big AI theme. Manus has been talking about it with Danny all morning over in New York. On the Nasdaq 100, we're higher by 0.9%. Let's get into some of those movers and cross over to Manus Cranny for more. Good morning, Manus.
Jonathan, good morning. At the epicenter of this new AI trade, Stargate is what it's called, announced by the President of the United States. And it's a trifecta. You've got SoftBank, you have OpenAI, and Oracle. Oracle is going to provide the gear, the cloud-based infrastructure. Bloomberg Intelligence say this gives them a nice leg higher. At one juncture, we put on $48 billion in market cap. This is about access to power, access to the deal, being part of the deal. And you get a nice tailwind is that Larry Ellison may be in the running to pick up TikTok. This is about building data centers, and the size of the capital investment that's being talked about here is between $100 billion and $500 billion. It's all about delivery. Let's just temper our enthusiasm. NVIDIA, it's all part of this. Again, it's about the ecosystem benefiting from the top-line growth in data centers and AI in the United States of America.
NVIDIA just trumped Apple in terms of market cap. So it takes that crown again as part of this supernova in AI, that narrative about what they're building here and what it means for the ecosystem. Roll it forward, and I'll leave you with a view on Netflix. You and Lisa can debate whether you watched some of the leading parts of this, Squid Game being one. The size of the subscriber growth is gargantuan. 19 million people signed on to Netflix in the fourth quarter. And they put through price rises globally. USA, Canada, Portugal, Argentina, bumping it up. Did you notice the price go up? Did you just press yes? I'll go ahead. This is about live programming from, sports on Christmas Day to the Tyson-Paul fighting match. You pay. That is about squeezing the average revenue per user. Remember that? And they're spending $18 billion on content. King of content, if you've got deep pockets and cash to spend, you win. Jonathan.
You need deep pockets to pay for Netflix and everything else. Manus Chronic, I feel squeezed all the time. When was the last time you tallied it all up? It's like hundreds of dollars now.
I don't tally it up, although...
Hulu, Netflix,
well, I go through
Peacock,
how much
Paramount.
do we use everything? Do you really have all of those?
Yes.
Oh,
Italian
well.
football on Paramount.
All right, maybe this is the issue.
British football on Peacock. Netflix just kind of exists. It's just there.
In case you want to watch Squid Games?
You know what? Netflix would be one of the first things we cut at my house.
Okay, I'm glad that we're doing this on
just
air.
Just throwing that out there.
All right.
I'm clearly quite alone on this issue because the stock is up double figures based on what Manus just told us. We need to talk about branding and the future of consumer companies in the United States of America and all around the world. And we can do that right now with Coca-Cola COO, Henrique Braun. Henrique, it's good to see you, sir.
Thank you. Thank you for having me.
Thank you for being here. Thank you very much, sir. I want to focus on branding. Marketing is a massive part of your company. And we can already feel the tension at certain companies, satisfying a progressive consumer and at the same time a more activist, conservative consumer in a way that they haven't been traditionally. How are you navigating those choppy waters?
Yeah, look, when you operate in 200 plus countries, you really need to adapt to the local needs and to the consumer trends that you have at the global scale, but also granular at the local level. What we have been doing recently is looking at marketing transformation that taps around our gaming, raising that connection through digital, through live and retail experiences that then connects with our portfolio of brands and packaging pricing in a 360 way that connects with the consumer at the local level, but also at the global basis, developing global brands.
Does it change how you operate as a business? We've seen many companies in the United States pull back from DEI initiatives, distance themselves from things like ESG, net zero. Where are you guys on that as a team at the moment?
Look, again, being a global company, parts of that, it's completely embedded into our business, the way we do and work in the different parts of the world. You have to face it. And then looking at the marketplaces that encompasses more than 200 countries, we have employees that we want them to do and work on a very collaborative way, and that's what we focus on.
How much do you lean into the sort of American branding of Coca-Cola at a time when we're talking about American exceptionalism and, frankly, America First, the policy that Paul Ryan, former House Speaker, was just talking about? Or how much do you think about other brands that sound kind of local, that kind of remove themselves from that story?
Yeah, we're very proud to have started our business in the United States, and Coca-Cola is an iconic brand all over the world, right? But you have to remember one thing. Over the years, we actually developed other brands in other parts of the world. Today, we have more than 20 brands that are more than $1 billion brands, and they range from places that started in North America, but also across the globe. So that's how we play that, playing the massive penetration that we have across the world, but driving the global brand scale to benefit our consumers.
I always look forward to Coca-Cola results for a lot of reasons, but in particular because you often break out foreign exchange implications at a time when we're talking about the strong dollar and how long the U.S. can diverge before it starts to hit back on companies. At what point do you see the strong dollar as a real liability because of that foreign presence?
Well, when you look again in our history, more than 138 years, we have seen it all. Right? All the different political environments and macroeconomic scenarios, you name it, we look at the pandemic days, how it shifted around and we had to adapt. I think one of the key things that we learned as a system working with our bottlers and the company together is to develop this strategy that we call all-weather strategy, that we're going to have tailwinds and headwinds coming in our ways in different markets. But the way we look at our plans is how we can build flexibility on that so that when we have these variances on FX, that they don't hit us heavily over time.
Could you give us some detail of that? Do you just stay unhedged and just say some years the dollar's strong, some years the dollar's weak, we just let this go? What is your approach to hedging?
We play the portfolio, right? So on the dollar's strength in the United States is actually good for North America, and part of our business, a great part of that, it comes from North America. Other parts of the world we can hedge because of the currency availability that we have in there. Others we just can't. But the way we play, it's a long-term investment. Usually what happens is if you have this long-term view and you invest with the right foundations, you go through these weathers that we have, and then in the long term we capture the balance of that as in an aggregated basis.
Henrique, one really difficult moment for global businesses, not just your own, was of course the pandemic. Working through the pandemic, we did have this big bout of inflation. At the time, companies were able to pass on higher costs with higher prices. The consumer price tolerance was there. And we saw that repeatedly from company to company across sectors and across geographies as well. Do you think that consumer price tolerance is there in quite the same way? Are we breaching the upper limit of that at the moment?
Yeah, well, the way we look at that, definitely when you look at the inflation and pricing, it's going to be more moderate. Right now, I would say that's more normalizing as it was prior to the COVID and pandemic days. When we just got out of the pandemic, then we had the inflationary markets. It's an adaptation. Again, having a game where you play affordability for the consumers, but also premiumization on the consumers that want to pay for innovation, for accessibility of convenience, that's how we balance it out and continue to win.
We've been talking a lot about vibe shifts here and a lot about the new administration as it comes in. And RFK Jr. is among those vibe shifts. And Make America Healthy Again. And then you also have the vibe shift of President Donald Trump with a Diet Coke at his inauguration that was presented to him by your chief executive officer. I'm just wondering, which is going to win out, right? I mean, it's sort of this question of, is there going to be a renewed focus on healthy drinks and really expanding that suite of healthier offerings?
Look, we have this very clear. The way you're going to win is following the consumer, right? And over time, we expanded our portfolio choices to different categories, to different calorie intakes, and that allowed the consumer to actually be empowered to have the choice that they want for the occasion that they want to have during the day. So that's the way we're going to continue to play.
All right, but is there sort of a bigger emphasis by the consumer on a certain one of those trends? Is there which are they leaning into, Diet Coke or sparkling water with a twist of lime?
Well, when you look at our results up to the Q3 last year, we continue to do pretty well across the different categories. So we see an opportunity to continue to tap the consumers in different occasions and different segmentations that is addressed by our brands. So Diet Coke will have a place, Fairlife will have another one, Maaza in India will have it, so all of them.
That's the drink I order.
What, Maaza?
Sparkling water, a little bit of lime.
I was just speaking to you. I was catering to
not a big
someone
drinker.
I knew.
Never drink at work events. That's my approach to Davos, Switzerland.
You never drink
sparkling
alcohol.
Water, ever.
Yeah.
Just a sparkling water and a little bit of lime. I can tell you the producer in my ear, big Diet Coke drinker, huge. Yeah. Every morning, bottles and bottles of it.
She's got a companion.
Good to see you.
Good to see you.
Thanks for being with us.
Thank you for having me.
Henrique Braun there, the Coca-Cola COO. Let's give you an update on some stories elsewhere this morning. We can cross over to New York and get you your Bloomberg brief with Anne-Marie Jourdain. Hey, Anne-Marie.
Hey, John. Migrant communities across the country are on edge as President Trump vows to start mass deportations. The president has issued new orders, including giving immigration agents the power to enter churches and schools. Trump has also reinstated the Remain in Mexico policy and announced plans to restrict birthright citizenship. Israel's top general and his Gaza commander resigned over the failure to prevent the October 7th Hamas attack. The move may add pressure on Prime Minister Benjamin Netanyahu's government to take responsibility. Lieutenant General Herzi Halevi will step down as chief of staff of the IDF in early March, around the same time the current ceasefire is set to end. And large parts of the United States are facing powerful winter storms. Temperatures are in the single digits across much of the Northeast and Mid-Atlantic regions, and several southern states declared states of emergency with record amounts of snowfall in New Orleans and parts of Alabama and Florida. That's your Bloomberg Brief. And John, I'll tell you, it's about 11 degrees Fahrenheit here in Washington. I think it's a sunny 35 degrees where you are in Davos, Switzerland.
I don't know who that was. Who was that just crossed us there?
I don't know, but it's sunny and it's beautiful and it's you know,
it's wonderful. Well, having a great time. All right. You can't just walk through. Anyway, up next on the program, striking the right balance.
At the end, this government is about growth. So therefore, I hope they will balance the implementation of those policies in a way that it doesn't either overheat the economy or triggers a recession.
It's remarkable to see the headlines coming out of the United States, threats of tariffs, and then see the European equity market at all-time highs. We had some more weight to the equity benchmark stateside. Equity futures on the S&P 500 up nicely by a few tenths of 1%. Look at the bond market, pretty stable on the 10-year at the moment, 457.24. Under surveillance this morning, striking the right balance.
When you think about the U.S. economy, it's in a good place. And then you have policies coming from immigration policies, tariffs, fiscal policies, and others. So at the end, this government is about growth. So therefore, I hope they will balance the implementation of those policies in a way that it doesn't either overheat the economy or triggers a recession. So I think that the hope is because of that.
Let's talk to a man who's seeing some real growth. Joining us now, the Gap Inc. CEO, Richard Dickson. Richard, it's good to see you, sir.
Good to see you. Thank you for having us.
Can I just say you looked the part. When you walked in, you were so upbeat. I said to you straight away, this is what the Gap CEO should be like.
Thank you.
What are you dressed in
live
today?
The brand. Today, it's pretty much Banana Republic. Top to toe. Underneath, we've got a little Gap and Old Navy. So it's a combo of the three, but I love our brands and love to wear them every day.
Whatever you're doing, it's working. The stock is up by more than 100% since you joined. Can I ask you, how often do you check that stock?
Look, first of all, it's thrilling to see the progress on behalf of our entire team that works so hard to see the investor community react the way they have for the fundamentals that we've been working on fixing is very rewarding. In the context of checking, I look in the morning and I look at night, and the rest of my day is spent driving the business and executing our strategies. And the better we do and the more that we do what we say, the more exciting it becomes for our shareholders.
We've got a little bit of time to sort of build this out, so let's start from the beginning. When you came on board, what did you identify that needed to change at the beginning, and how far along the process are we, just in terms of what you wanted to do?
Look, Gap portfolio, Gap Inc. has amazing brands. Gap, Old Navy, Banana Republic, Athleta. These are legacy brands. They're storytelling brands. They're brands that have incredible recognition around the world. They were brands that were built on great merchandise and merchandising and great execution. And along the way, we became a retailer that sold stuff. We had brand familiarity and we had fans out there, but we lost the storytelling part of our brands, and arguably our brands became less relevant. And so we needed to really go back to the roots of each one of our brands and talk about what is the brand purpose? Why are we here? How did we get here? And so each one of our brands follows a playbook, and it starts with the purpose of every brand. Then we study the insights, consumers, and trends, and we create amazing product at distinct value. And we then connect that product to great storytelling through marketing that's culturally relevant. And last but not least, as a retailer, retail is detail. And so execution matters above everything else. That's a combination of a lot of sequencing that takes a lot of time and diligence. But the proof is in the metrics, and we're making a lot of progress.
There's a lot to unpack there, including marketing that's culturally relevant. I'm thinking influencers and how you sort of have tapped into different voices other than just non-traditional advertising. How big of a shift was that to work with individual people and kind of hitch the brand to them?
Yeah, well, I'll tell you, it was a shift. But with our brands that are legacy brands, we went back to the origin story of how did these brands begin with, right? And although marketing has evolved and the media landscape has evolved, today it's really important to be where your consumers are, and they're everywhere. But when you have a clear purpose and precise brand values and great product with great perspective, you can drive a lot of synergy across multiple platforms and feel like it's one voice. And a lot of the work that we've been doing has created that brand personification, whether it's through influencers, social media, the digital dialogue. You need to be everywhere your consumers, but you need to be there with creative that's precise, and you need to be interesting to get people interested. And we've done some really good work so far.
It's fascinating to me because there's both a shift away from fast fashion and then there's uber fast fashion that's coming off some of the social media trends that people hop onto and want to buy through the social media networks. What's the complication in dealing with this sort of very rapid fashion, especially at a time where there's some uncertainty about supply chains as well as some of the international relationships?
Sure. First, I would say we're not fast fashion. We're generational brands. We're legacy brands. We have incredible key items that people depend on, khakis and Oxfords and denim and Athleta with key core concepts. So we are certainly fashionable, but we're also very reliable for great product at great value. We then have a layer of fashion that follows and in some cases defines trend, but you never want to be too trendy. We want to be on trend, but never too trendy. And that's the balance of the art and the science that goes into our brands and any brand for that matter. Fast fashion tends to be faster with trends. We're getting faster at creating new and exciting product into our stores, but we have reliable, great basics with great storytelling, great value, and great style.
Well, originally during the first Trump presidency, there was a question around retailers and how much they would get hit disproportionately from potential tariffs. How are you immunizing some of your supply chains from tariff uncertainty, let alone the actual tariffs themselves?
Yeah, well, I would give credit to our supply chain team, and they've done an excellent job over the last several years diversifying our footprint. Our manufacturing footprint today is really fully diversified. Less than 10% of our product is coming out of China. We really have a fantastic global supply chain that is driving incredible product development all over the world. Tariffs, as they come, we'll be able to navigate and deal with it, as everybody will. We're not, in isolation of the overall challenge. But it's our job to create great value and great style and execute with excellence. And it's our job to figure out the P&L ramifications of that, but make sure that our consumer proposition stays intact. And that's how businesses get through these type of scenarios.
As you pulled back from China, could you give us a sense of where you went, where you diversified to?
Southeast Asia, Central America. We're in India as well. We've got Vietnam as one of our great sourcing countries. So we've got a really diversified footprint, and we continue to expand and explore. And in some cases, going to developed markets and developing markets using our platform to bridge opportunities. I think one of the points of pride of the heritage of our company is we bridge gaps to create a better world. And much of the work that we're doing here in Davos is learning, connecting, listening, and living our purpose to bridge gaps to create a better world. And in some cases, bridging the opportunity gap is going out and developing product in places that need that work and need that company to come in and really grow that market.
One place where a lot of people went to was Mexico, and we could sit on Central America just for a moment. If we do get tariffs and they do hit your costs, and you do have to pass on those costs potentially to consumers. One thing we're trying to gauge here in Davos is just how much consumer price tolerance there is right now. For your business specifically, how do you gauge that at the moment?
We're in a business where we need to create wants. Now, that in the context of our business, fashion is about emotion. It's about storytelling. And we're all consumers. And we all have different thresholds for what we'll pay for that value proposition. In our case, with our brands, again, we rely on a great product, great value, and great style. And we will figure out the right value proposition along the way, no matter what the tariffs are. That's for us to really figure out and for us to continue to have that consumer resonate with our brands.
We were speaking to Coca-Cola just moments ago, and we started the conversation on the challenges between engaging a progressive consumer and making sure you don't isolate a conservative consumer. Is that balance getting harder as we come into 2025?
No, I don't think so. I mean, from our perspective, we have a wide range of consumers. We have value propositions. We have, limited distribution concepts. We create scarcity. We've got a variety of different products and programs that really address all consumers. And that's the beauty of our brands. And so as we migrate into another chapter and another year with lots of challenging conversations and business dynamics, again, we're very focused on our strategic priorities, very focused on creating great product, great style, and great value, and executing with excellence. And we will, of course, continue to deliver those metrics and do what we say.
Who do you think is your biggest competitor going forward? Zara, H&M, Walmart?
Look, I think you're competing for consumers' interest. And I think we have to be better storytellers. And to the extent that we would target one or another, I don't really think in that regard. I really think about who we are and how to identify our brands with meaning and matter and substance. And the consumer will choose. And as long as we continue to do what we say and tell great stories and present our products in the way that we have been so far, I do believe that we will continue to win.
Richard, this was a pleasure. It's fantastic to catch up with you, sir. Let's do it again in New York soon. Richard Dickson there, the Gap Inc. CEO, on the success, Lisa, that they've had, particularly over the last year.
Yeah, as they really kind of go back to their roots while using modern skills, technologies to try to disseminate the message. The idea of what modern marketing looks like has been something that's absolutely fascinating at a time where there are different generations that are absorbing information in just completely different ways.
I need Richard's stylist. I think we need to sort this out.
I think that he will sort it for you,
Yeah,
no problem.
I think he's
You want to be the poster child for it.
Next year we do this,
Yes.
I just won't be sitting here in a suit and tie.
We can take care of that for you.
Yeah, we'll work it out. I look forward to that. Up next on the programme, we'll catch up with the Nasdaq chair and CEO, Adena Friedman. Looking forward to that. The former US ambassador to Switzerland, Ed McMullen. The Cisco CEO, good friend of this programme, Chuck Robbins, joining us in the next hour. And look out for this on the market. The Bridgewater co-CIO, Karniol-Tambour. Do not miss that. From Davos, Switzerland this morning. Good morning to you all. Stateside, your equity market rallying on the S&P 500. We're higher at the moment on the S&P 500 by 0.5%. Over in Europe, here in Europe, Lisa, the Stock 600, all-time highs.
Yes, definitely getting some sort of push maybe from the belief that a lot of European companies have more and more exposure to the United States.
It's amazing that we're just shaking off these tariff headlines, isn't it, over the last 24 hours?
In fairness, they could have been worse, and that's what I think a lot of people are leaning into.
They may well get worse. The third hour of Bloomberg Surveillance is up next.
I think the inaugural speech was essentially an advertisement for investing in America.
U.S. is at the epicenter of all discussions.
The U.S. labor market has been the most resilient labor market in the world.
I don't see a lot of merit in drill, baby, drill. I see a lot of merit in build, baby, build.
I think we're going to ultimately have to see what the year brings because there's still more unknowns than knowns in the equation at this point.
This is Bloomberg Surveillance, live from Davos, with Jonathan Ferro and Lisa Abramowitz.
Live from Davos, Switzerland, for our audience worldwide. To those of you stateside waking up, good morning to you all. The third hour of Bloomberg Surveillance starts right now. And this market is taking a lot in its stride, particularly over the last 24 hours. Equity futures elevated on the S&P. We've said it repeatedly through this morning so far. Record highs on the Stock 600. Lisa, the gains continue.
A lot of people are optimistic about the flows in the U.S. spilling over to other parts of the world, which is ironic considering some of the tariff headlines that we've gotten on the likes of Russia as well. Yes, if there is some ongoing conflict, but also with Mexico and Canada, as well as Europe. And, of course, China. A real question here, though. Shouldn't it have been worse given some of the rhetoric? And so maybe that's feeding into some of the optimism that we see certainly in market pricing.
I think this is just the repeat of a lesson that we all learned in Trump Volume 1. Wait, and things will change. And wait maybe just a few hours. It's only a few days ago that I saw people on Bloomberg, on TV, heard them on radio saying the same thing. But China and Europe weren't mentioned. That's probably a good thing, right? And then Europe and China get a mention overnight.
At the same time, maybe not as extreme as people thought, and people are looking between the tea leaves and trying to understand where the optimism will be. I will say, if you have the takeaway here, there are two things. There's a sense that there will be less regulation around companies and corporate tie-ups, and that alone is giving a lot of optimism to people, regardless of some of these other potential options. And there is a sense, we've already been through the pandemic, we can adjust and adapt, and I know I'm repeating a line that Tom Keene used to say all the time, but companies feel more resilient than they have in the past.
Without a doubt, and for good reason, because those balance sheets have been incredibly strong through the pandemic and coming out the other side. We need to talk about the President of the United States. For that, we head
to the nation's capital to catch up with Bloomberg's Anne-Marie. AMH, it's good to hear from you as always. There will be an address tomorrow from the sitting president to Happy Valley. Lisa mentioned it a little bit earlier. How happy will they be once that address is finished?
I'm not quite sure they're going to be very happy. I was looking back at President Trump's remarks when he was the 45th president in 2020 when he went to Davos and gave this speech, and this stuck out for me. He said, while many European countries struggle with crippling energy costs, the American energy revolution is saving Americans money. And then he talked about how America no longer needs to import from hostile nations. And with an abundance of American natural gas now available, our European allies no longer have to be vulnerable to unfriendly energy suppliers either. I think that is something that, as the 47th president of the United States, the fact that we saw Russia invade Ukraine, and Russia has been this massive supplier for decades to Europe, he might remind them that it's time to buy some more U.S. liquefied natural gas. I believe in his first go around, he used to talk it freedom molecules. So I expect he is going to give a warm welcome that he is back to Klaus and some of these distinguished members of the World Economic Forum. But I imagine he's also going to needle a lot of all these European countries and remind them of some of the words and warnings he had the last go around.
Anne-Marie, dead on. The sitting president feels vindicated. Some of the warnings that he had for the Europeans over the first administration, the first term over those 4 years, he was laughed out of the room at some of those places, Lisa. I remember the comments that we saw afterwards when he said things like NATO wasn't spending enough, that it didn't make sense to provide military security to places like Germany when they had a multi-billion-dollar gas deal with Russia. And we've seen all of that break down over the past 4 years.
There's a sense, and just to sort of push that forward, here in Davos, there is a very different tone with respect to how Europeans and others in other non-U.S. countries are treating Donald Trump, because they are taking what he says seriously and they are looking at what they can do to boost their own competitiveness rather than just say, this is wrong, this is against what we've known in terms of the Western order.
Europe has a growth problem, which is why they need to be pro-growth in the same way that the US administration is being. And I'd go another step as well. These leaders in Europe are increasingly vulnerable to movements on the right of where they are politically in those nations, Lisa. And I think that's another wrinkle in all of this for them with a new president.
Which maybe is the reason why there are many fewer sort of highfalutin statements here at Davos. It's much more, let's get the deal done, let's talk about what you're doing, what I'm doing, and a lot less sort of very moral speech, which is actually what we used to hear much more in these Happy Valleys.
A big focus on core competency as we kick off 2025. Let's do that now with the Nasdaq chair and CEO, Adena Friedman. Adena, it's good to see you.
It's great to be here. Thank you.
Can we just start with vibes and tones and feelings? As an American executive in Davos, Switzerland, how upbeat is the mood?
Well, I would say that it's actually, just as you all talked about, it's really focused on pragmatism, right? So how can we learn from what the U.S. is doing? How can we make sure we're being competitive ourselves in the European nations or in other countries in the world? How can we continue to work collectively and productively with the U.S.? And also, but mostly, how can we kind of follow some of what the U.S. is thinking, right? So deregulation, or what we like to call smart regulation. So thinking differently about regulation and where are the areas where it's effective, where it's not effective. How can we make sure that we are driving growth, productive growth, long-term growth? I think there are other parts of the world that can learn a lot from that as well as we go through that process. And we're very excited to engage with the new administration to think about regulation differently. Regulation is very important in the financial industry, but there's, I would call it outcome-oriented regulation that's effective and can be efficient. And then there's input-oriented regulation, which can be very ineffective and inefficient. And we've done some work on that to understand what's the difference and how can we engage with the administration to make sure we make the entire industry more productive.
Could you describe in some detail, if you can, just some of the specific changes that you'd like to see and what kind of outcomes they would develop?
Yeah, so we've really thought about the outlook for the year. And first, it is going, we think, a very constructive year for new issuances and IPOs, and we can talk about that. But we still have a challenge, a regulatory challenge, in terms of companies and what they go through as a public company. We do think there's opportunity to work with the administration to rethink some of the levels of regulation and requirements for public companies themselves and make sure that it's more balanced between being a public company and a private company. I think the second is, of course, on the financial system itself. And we've done a big study in partnership with BCG on what we call complexity versus complicatedness. There's a lot more complexity in the world. We know that. But over a 50-year period of time, there's been a 6-time increase in complexity across every industry across the world, but a 35 times increase in complicatedness. And that's really because of you take a complex environment or you take a crisis situation and you regulate behind that. And suddenly you've got all this complicated work that you have to do and you're racing to get it done and you're not optimizing for the outcome. As a result, you've got a lot of layers of regulation. So we think that there's new technologies, a way of sunsetting regulations, thinking about regulations in a different way. We actually we do think there's a real opportunity there to make sure the industry can be a lot more efficient.
I want to drill into the first part of what you said. The idea that if you strip away some of these regulations, it would make it easier and maybe even out the disparity between private and public companies. Do you think that that is the reason why we have seen a drop-off in IPOs, because of the extra regulation and how easy it is to get financed through the private markets?
I do think it's an ingredient. I would say that, there are probably several factors that kind of drive the balance between public and private markets and the swings that can happen. One, of course, is in fact, monetary policy, right? So big swings in monetary policy make public investors more cautious, change the way that they model companies. And that alone can make it so that you just don't have as many companies coming out. And I think the last 2 years or 3 years has been more around monetary policy. But longer term, the balance between public and private markets, I think, has been heavily impacted by regulation. You go public and suddenly you have enormous amounts of disclosure obligations in the proxy. You have it with the PCAOB in terms of accounting obligations. There's a lot of publicity around everything that you do, and there's a lot of public scrutiny around everything that you do. And then you, of course, have the quarterly earnings process, which, is difficult to navigate if you have a long-term strategy, but you have short-term milestones that you have to, continue to describe. So all of that just makes it a more complicated existence. I think some of that's just part of being a public company, but some of it in terms of proxy, there's a lot we can do in proxy reform. There's a lot we can do in accounting and disclosure reforms, and of course also litigation reform that I think could really make the nature of being public a lot more attractive.
We hear a lot here about how deals are going to explode and how there's so much optimism and the pipeline's getting so much bigger. Are those deals going to be IPOs, or is it going to be a structurally lower volume type of market just because there are so many other options?
Well, actually, I look at it as they're complementary to each other. So if you are a private equity firm or you're a venture capital firm and you are making an investment in a private company, the most important thing you can think about is how are you going to exit? And usually you like to have a couple of different options on how to exit. You could exit through an acquisition, or you could sell it, or you can exit into the public markets. But because of the fact that there has been very little M&A and the M&A environment has been very challenged from a regulatory perspective, that door has been pretty closed. That makes it so people just don't choose to exit. They always want to have optionality. If they only have one door to get out, they're going to wait until the other door reopens. The other door is reopening now. So we do think a much more accommodating environment from an M&A perspective coming, and that will then make them evaluate exits, and I actually think it'll result in a lot more IPOs.
How much do rates need to go down to really grease the wheels for that?
I would say this. I do not anticipate the rates will decline much this year. I don't think we should expect that. We're a resilient economy. We're growing well. Inflation's back into a relatively normalized state between 2% and 3%. But we also have a lot of new economic policies that are coming out and a pro-growth agenda. At 4.5% risk-free rate, that's a very normalized environment to operate in. That's a rational cost of capital to make rational decisions in. We can operate in that world and grow really nicely for years. In fact, we want it to be something in that range because that means we're growing as an economy.
It's true. I want to finish on a question that Lisa asked a little bit earlier this morning. Thought it was excellent. Have you spoken to any businesses here that would like to list in the United States? Are you seeing that as a growth opportunity to attract those companies and those listings to you and to maybe take some of that business away from foreign financial capitals?
So we do have conversations about that. But we have those conversations here and elsewhere.
Have they picked up?
Think about it this way. We have 4,000 listed companies on Nasdaq. And we might have, let's say, 150 to 200 IPOs a year. And we've actually had 500 companies switch from New York to Nasdaq. When we're talking about having conversations about companies here in Europe coming to the U.S., it's like 5 or 6, maybe 10. It's not like 100. The public markets here are also very vibrant. We own and operate the markets in Sweden. They're an incredible market ecosystem. So I do think that the markets here in Europe, a lot of work to do to create a better union in the capital markets. But I still think that there's a great cadre of listings that are here and will stay here.
I think I can speak for all the companies across Europe. They just love the American valuations, right?
Oh, absolutely. I mean, they can get such high.
Without a doubt. Adena, it's wonderful to see you. Thanks for dropping by.
Thank you.
Thank you. Adena Friedman there, the Nasdaq chair and CEO. Let's get you an opportunity to go through some stories elsewhere with your Bloomberg brief. Here's Anne-Marie.
Hey, John. President Trump has announced the formation of a new company that will invest $500 billion in AI infrastructure and create more than 100,000 jobs. The company, called Stargate, will come together as a $100 billion joint venture between SoftBank, OpenAI, and Oracle. Goldman Sachs and JPMorgan are the latest firms caught in the anti-DEI crosshairs. Sources telling the Wall Street Journal that activist groups are privately pushing the banks to abandon or shrink DEI efforts, saying the bank's policies leave them and their shareholders vulnerable to costly legal challenges. And 3 legendary baseball players have joined the sport's most exclusive club. Ichiro Suzuki, CC Sabathia, and Billy Wagner were all voted into the Baseball Hall of Fame. Ichiro was just 1 vote shy of becoming the second ever unanimous selection. You just have to ask, John, who is that one person that decided not to vote him through unanimously? It's getting a lot of buzz on Twitter. That's your Bloomberg Brief. Back to you guys.
Anne-Marie, appreciate the update. Thank you. More from Anne-Marie again in about 30 minutes' time. Up next on the program, America First.
The best way to describe it is America First. A lot of good fiscal policy, regulatory policy, tax policy. There's a lot of optimism, frankly. But on trade, I mean, I'm sure you have an international audience here. There's going to be some trade friction, no two ways about it.
Equities doing nicely so far this morning, going into the opening bow 1 hour and about 14 minutes away. Under surveillance this morning, it is very much America First.
The best way to describe it is America First. I think he's articulated an America First. On trade, it's a little more mercantilistic, say, than the traditional Republican, Reagan free trade. But America First is the quickest way of describing it. A lot of good fiscal policy, regulatory policy, tax policy. There's a lot of optimism, frankly. But on trade, I mean, I'm sure you have an international audience here. There's going to be some trade friction, no two ways about it.
Former Speaker Paul Ryan making exactly the same argument that we heard from the incoming Treasury Secretary Scott Bessent on the need to pass the Tax Cut and Jobs Act extension. Scott Bessent warned of a calamity for the U.S. economy, and we heard something very, very similar from Speaker Ryan just moments ago.
That basically you need a growth environment if you want to have something that really matches the deficit that we have going forward, and that seems to be what people are looking for.
The equity market right now, if you're looking for the equity market, it's doing quite nicely, up by a few tenths of 1% on the S&P, up more on the Nasdaq. With some morning calls, let's cross over to Manus Cranny for more. Hey, Manus.
Hey, John. Very good morning to you. Netflix, there's 19 million people signed up here, so we've got a nice upgrade. Barclays upgrading the stock to equal weight. They say that if it sustains the current operating momentum, well, that could certainly drive the upside. Good numbers in the fourth quarter. Wells Fargo comes in on 3M. They go to overweight. They say that it's early days of significant margin expansion for them. The stock is up just under 1%. And finally, Morgan Stanley cutting the price target on Microsoft to $540, citing investor sentiment shifting negative around its gross margins. One of the laggards, you could say, in the big tech story this morning. John.
Manus Cranny, thank you, sir. Appreciate it. I'm very pleased to say that we can pick up where we left off, the conversation on America First. Joining us now, the former U.S. ambassador to Switzerland and a good friend of this show, Ed McMullen. Ambassador McMullen, it's good to see you, sir.
Great to be with you all.
Let's talk about a new administration under President Donald Trump.
Yes.
The first 2 days, and some clarity maybe on what the approach is going to be to things like trade. What's your advice to people here in Switzerland today?
Well, one of the most important things I think we have to recognize is this isn't new. The trade terrorism that's going on right now, the idea that the media, not you, of course, but others in the media, are trying to tear this up, make it look like there's something devastating that's coming. President Trump's been president for 4 years before. He's talked about trade. He's used it effectively. And we think that the next 4 years are going to be very clear If you're a trader and you're looking as a country to do reciprocity with the United States, bottom line, you'll have a good environment. If you're looking to take advantage of the United States through tariffs, which many countries do, you're in for a new rude awakening. And the president's been extremely clear on this. It is not a threat, it's a reality.
We've understood that pretty well. And I think a lot of people that follow this program agree with that, particularly with regards to places like China.
Yes.
They might struggle a little bit more. They probably will struggle a little bit more with places like Canada. Where's that tension coming from?
Well, I think the fear is unfounded. All you have to do is look at what happened in the first term. The president has given us a great roadmap. Canada basically had dealt with its paper issues and its help paper issues and other problems they had in the first term. But the president came to the table and all came to the table and came up with solutions. And we had a good agreement that actually fixed many of those problems. So it's a dialogue, it's a conversation, and it's clear as day that the United States is done being taken advantage of by others' tariffs. We won't be going there any longer.
So it's a negotiation with maybe
Absolutely.
Canada and Mexico. Is it a negotiation with Europe? Is it a negotiation with China?
Well, I think Europe is one thing. We're not negotiating with the EU. We're negotiating with individual countries, working with sovereign nations and their bilateral agreements that they have on trade. I think that's the bottom line. That's the focus. Working closely with countries who want to do trade with the United States. The terms are very clear. If you have reciprocity, if you're willing to trade without tariffs on our country, then you'll be in a good position to have a conversation and an agreement.
At the same time, there's some other parameters around some of the tariff threats. And yes, we're talking about Europe maybe buying more LNG, which is basically like opening a door that's already open, as we've talked about. Yes. But there is this idea that with Mexico and Canada, it has to do more with border control and some other potential issues. How quickly do you see that all getting resolved? I mean, how long are we going to get these headlines that are going to whip some
Look,
markets?
I think one of the great assets, and I'm hearing this all over Davos right now, there's a great optimism. You know, we read all the media, how terrible things are, how dark the New York Times, dark speech. I've had more people tell me, CEOs, business people, who said it's a time for optimism, and it is. Scott Bessent is an amazing advocate inside the Treasury. He is a close friend of the president's. The president trusts him. He has a macro and micro vision of the economy that Janet Yellen never even understood. I think the excitement, the eagerness, and optimism to have agreements and trade conversations in the way we've never had them before is extremely strong, and it's going to be an exciting time and an optimistic one.
I will say that everyone we've talked to, optimism seems to be the presiding sentiment for absolutely everyone.
If they come from America.
Well, yes, but if they're not, they're talking about how they want to get some of
I'm actually hearing
theirs.
that from Europeans.
Yeah.
What are they saying to you, Ambassador?
They're basically saying, great speech. We're really looking forward to a term like we had in the first term. And I keep saying, look, that's the roadmap. There are no surprises here. The president has not changed his view on tariffs. And they all survived very well when they came to the table and negotiated and did what needed to be done.
We were speaking to Anne-Marie moments ago about the president's address tomorrow to the World Economic Forum. A sense that perhaps he feels vindicated from some of the warnings that he made to the Europeans in his first term that maybe went unheard.
Right.
And he turned out to be right. With things like foreign policy, the relationship between Germany and Russia, what was going to happen with energy. I'd like to ask you this, why you believe as a conservative, the conservative argument is winning at the moment, not just in the United States, but perhaps elsewhere?
Well, I was ambassador to Switzerland and Liechtenstein at the time President came to Davos in his first trip. He came here because the fear-mongering that was going on for so long had Europeans in uncertainty. The president came here into the belly of the beast in Davos, and he said, America first does not mean America alone. And that gave people a confidence and an understanding that our foreign policy, this president understands America first is critical. We have things that need to be fixed, things that he's talked about extensively, immigration, tax policy. But we also know that as America goes, so goes the world. We have a responsibility. The president takes that extremely seriously to fix the problems in the United States. And that's what he's intending to do. And I think the Europeans and the business world knows this. That's why the markets are doing so well. Scott Bessent's got a lot of confidence in this town, I can tell you. And also in the United States. I hear people day in and day out talking about how wonderful things look going forward. We finally have certainty. If you don't disagree with the president, the one thing you will know is you don't have to guess where he's coming from.
I don't have to guess where he's coming from, but I do have to guess where he's going, particularly on tariffs. And I wonder what the price of that uncertainty will be. I understand that it's a feature and not a bug. It's a negotiation. But in the meantime, if I'm a company, I've got to operate with a backdrop of not really knowing what things will look like going forward. How quickly will we get that clarity?
I think there is clarity for those companies, those countries where there is extensive investment in the United States. Switzerland has over 450 companies operating in the U.S. Their goal is to make sure that that continued flow of trade works unfettered. It did in the first term. It will in the second term. Manufacturing, there are some areas in steel and other areas that we have some pharmaceutical issues as well, where there'll be a discussion and a dialogue. But I mean, business is business. Things are going to do well under a man who is a businessman and understands it better than anyone.
You mentioned that President Trump has been to Davos before. Is he going to come again?
He's been twice while I was ambassador. Exciting times because he can do these speed bilateral meetings where I think he had 12 or 15 meetings a day. And rather than flying around the world, he got substantive work done. He did amazing work. And he did give confidence to the world global economic message, which is the United States is open for business, excited about business, and we are the superpower that we should be.
I'm not going to win any friends at the World Economic Forum by saying this, but if you wanted to set up a conference business in Mar-a-Lago for next January and the president wanted everyone to come to him, I'm fairly confident not many people would come to Davos anymore.
I think the president has got a message that people here in Davos do understand. You've got to sift through the nonsense, get to the facts. The first term was a clear roadmap of where we're going, and there's a great future for America and the world for peace, prosperity, and liberty to thrive.
Ambassador, you're a gentleman, and it's good to see you.
Thank you,
for your
sir.
time.
Great to be with you all.
The former U.S. Ambassador to Switzerland, Ed McMullen. From Davos, Switzerland, up next, Chuck Robbins of Cisco. We're 60 minutes away from the opening bell over in New York City, and equity futures are doing nicely on the S&P 500, higher by 0.6%, thanks to some stability in the bond market, but really news elsewhere. Netflix is absolutely flying. The AI story gets another pump of confidence overnight from the president, Donald Trump. And Manus Crowley has a whole lot more on that and other stories right now with your morning movers. Hey, Manus.
Jonathan, Oracle quite literally is pumped up, adding nearly $48 billion in market capitalization on this story that President Trump wants to launch a new AI initiative called Stargate. And just carrying forward from Ambassador Mullen's conversation with you, this is not America first, America alone. This is a trifecta of SoftBank, Mayoshi-san, of OpenAI, Sam Altman, and of course Larry Ellison over at Oracle. It's a combination. It's a coalition of the willing in terms of tech. And to that end, it's about building data centers in ChatGPT. BI say it's a considerable boost for Oracle because they are the chosen one. The trickle-down effect goes to NVIDIA. It now takes the crown away from Apple as being the most valuable company in the United States of America. If you believe in this supernova of the AI trade, about moving the differential between the United States and the rest of the world, then you believe in the triumphalism of NVIDIA. New data centers, will they really scale up and spend $500 billion? That is the unknown known. That's the promise. I'll leave you the view on Netflix. 19 million people signed on. They were happy to press yes to the prices. They've raised prices as well. Not just 19 million people subscribing in the fourth quarter, but they're paying more in Canada, US, Portugal, Argentina. $17.99, up $2.50. Did you notice? Did you pay the extra to watch the football game on Christmas Day? Did you pay the extra to watch the fight between Tyson and Paul? Those are the incremental add-ons that will boost and continue to boost the ARPU in this. And they've got deep pockets to spend on content. They're going to spend $18 billion. That is a vacuum cleaner in terms of taking content for them away from somebody else. Jonathan, Lisa, good morning.
1,000 as Manus Crowley speaks. Manus, thanks for that. Just phenomenal performance out of Netflix. I had absolutely no idea they'd put up prices. Did
really?
you? I had no idea.
You just don't pay attention because you don't like Netflix.
I'm totally desensitized by the emails that I get from Hulu on such a regular occasion now, which is basically every few months where they're just like, we're putting prices up again.
Which means they're doing their job well.
Yeah, that's one way of putting it. Let's not have that conversation. Let's join the Cisco CEO, Chuck Robbins, for a much more important conversation. Chuck, it's good to see you, sir.
Well, it's good to see you, and I, too, don't probably notice when they raise it. Isn't that
exactly.
bad? Yeah.
We should go through it and tally it up, because I think it's up there, Chuck. Confidence is sky high, particularly among the American executives attending the World Economic Forum this year. You were really picking up on that increase in confidence anyway, because you lifted your outlook. recently. Can you start there with us? What underpinned that, and what makes it a little bit sustainable for you?
Well, first of all, thanks for having me. And you know, we're in the last week of our quarter, so this is all backward looking at the prior quarter results. And in our first quarter, we just had strong performance across the board. We talked a lot about a target that we put in place for networking infrastructure underneath these AI clusters and the web scale cloud providers, and that was our first quarter of the year, and we were ahead of linearity against that target. So we talked a lot about that. We're beginning to see the enterprise customers actually spending on infrastructure to support AI and or modernizing their infrastructure in preparation for AI. So overall, just things are going pretty well.
How much of a growth story is that already for you and the team, and what will that look like in the years to come?
On AI?
On AI, specifically.
If we do our jobs right, which I expect we will, it should be a tailwind for us for quite a while. I mean, we're designing new silicon right now for the next generation, and we're actually parallel pathing silicon. So we used to be a 3-year cycle. Now we're trying to shrink it to 12 to 18 by designing the next chip before the first one's even out. And we're rolling that technology across the portfolio. And I think the other big thing is the enterprise customers are really looking for partners to help them understand how to navigate this and how to actually deploy this stuff. And we're going to play a big role, and also how to secure it, which is a very big deal.
There's a sense that some companies don't know how to use AI yet. They don't really understand exactly how they can implement certain programs that can make people more efficient, exactly what they're going to do. How much are you seeing people spending versus asking questions, figuring out what they want to do?
It's a good question. We did an AI survey recently of our customers, and you've got basically all of them say, 85 to 90% say, I have to have something done in the next 18 months. And only 13% of them say, I know what to do and I'm ready to go. And so I think there's a lot of discussion going on. They're looking for it. We had a product launch last week called AI Defense, and it really allows our customers to put guardrails around their own models that they're running on their own data to actually protect their data. And it's the first it's come out that does this. And we had roughly 40 Fortune 100 customers in the crowd, plus government customers, and almost every one of them said, we want to go to field trial now. They're looking for what to do. So and I think the more innovation that we can all bring that helps them see how this is going to come to life, that's what they're looking for.
A lot of times your revenues are representative of confidence in a lot of companies, right? And that if they invest more in their infrastructure, that means they have confidence that their companies are going to grow. Is it saying something slightly different because people are worried about being left behind if they don't get ahead?
There's both elements exist today, because I think there's an overarching characteristic of the current CEO group where they don't think about what normal is anymore, because there hasn't been one for a very long time. So we've all become CEOs in times of crisis or crazy things going on around the world. So 15 years ago, you would hear a CEO say, we're just going to pause until things get back to normal. And I think the current group of CEOs just say, well, this is normal. And then the thing you mentioned kicks in, where I think, particularly with the speed at which AI is moving, a lot of the CEO community believe that, hey, if we're not doing it, my competitors are, what's going to happen to me in 6 months that I don't know about? And so there is a fear, but there's also a healthy concern around making sure you do it right.
As we develop these technologies, how do you see it when it comes to countries versus countries, nations versus nations? Do you think this technology will be kept within borders or be shared internationally? Will it become increasingly difficult to be a multinational selling this technology around the world? Will we have a series of national champions competing with each other? How do you think about that future?
It's a good question. I think look, friendly allies are going to share this technology. I think when you get to the data, that's a different discussion. I think the underlying technology is one thing, but we had already seen, sovereignty of data, sovereignty of cloud nodes, and that's emerging. And if the world continues to get splintered through geopolitical tension, then you may see more and more of that. The reality is that there's not a lot of companies around the world who can build a lot of the technology that's being delivered right now. So we got to navigate that as well.
Have you spoken to the president about this issue?
No.
Never in the past?
Well, in the first administration, we talked a lot about it, yeah.
What advice would you give him?
I think, look, the announcement they made this morning was great. I think that I think the thing about this administration is that there's going to be a lot of access for a lot of opportunities for us to have these discussions. And I think, I was in discussions back then about how we should be thinking about chips and things like that. And so I think he's got a lot of smart people around him, and I think they'll do the right thing.
We saw some of that, as you say, overnight in the last 24 hours. There's also a big celebration taking place this summer. You know where I'm going with this. I hope we're invited to the party. 10 years at the top of Cisco. A lot's changed since then, and we've talked for a long, long time over the years about some of your strategy, the shift towards software, to recurring revenue, to subscriptions. Are you happy overall with the strategic shift and how far along in the process you are?
Yeah, I mean, I think we hit 57% recurring, which 10 years ago we weren't close to that. There's a cap at some point, and to be honest with you, this AI explosion and the infrastructure that we're pushing out right now has got most of our attention relative to where we're investing, that in cybersecurity. So we never intended to get to 100. We never will. So I think we're on a good path, and I think right now we're almost unilaterally focused on building this AI infrastructure and building the security to go with it.
How much going forward are you going to have to focus on one country or another? Just going back to what John was talking about, because this is something where if you create, speed accelerators in one area, but you're using chips that might have some sort of national security overlay on them, how much do you see this fundamentally changing the way you do business?
I don't think we're going to face those issues. One of the things that we have really done over the years is we've tried to build great relationships with governments around the world, and there are multiple companies that build the technology that we deliver, not as well as we do, but of course. I think the bigger issue we're going to have to deal with is just every country is going to have a certain set of requirements they want you to meet in order to operate there, and they're not the same. So one country wants manufacturing, another one wants you to launch a public cloud node there, another one wants you to never let data leave the borders. So it's made business more complicated dealing with those issues, but it is what it is, and we all just have to deal with it.
One thing that we've heard increasingly from shareholders, particularly of the big tech companies, is concerns around how much they're spending on some of their infrastructure. Yeah. Do you start feeling some of your customers pushing back on price more and more, or is that basically, we will want this at any price so that we aren't left behind?
Well, they won't say that, but I don't. We tend to be able to get to prices that work for them and us. So the great news about designing our own silicon is we don't have to go buy it from a third party. So we have that value chain and the margins that go with it, so it allows us to meet their price points.
I remember that call more recently in the last year or so. You know where I'm going with the Google executive.
Oh, yeah.
Sundar Pichai, when he turned around and said the biggest risk here is not overinvesting, it's underinvesting.
Right.
And that's what a lot of them are saying, that essentially they will miss more by being behind the trend that all of their peers are getting ahead of.
The conversation I'm having with them is they're asking us, can you please deliver more? They want more capacity. They want more supply of the silicon and the systems that we're building.
So you don't have a demand problem right now?
No, not from them.
Have you got a supply issue?
Well, we just can't build it fast enough. So, but we're making progress.
No doubt about it. Chuck, it's good to see you.
Good to see you all.
Thanks for dropping by. Thank you, sir. Chuck Robbins there, the Cisco CEO. With an update on stories elsewhere this morning, let's get to your Bloomberg brief and cross back over to Anne-Marie.
Hey, John. Here in Washington, D.C., the Trump administration put federal employees in diversity, equity, and inclusion roles on paid leave and ordered those programs to be shut down. In a separate order, the administration moved to limit diversity preferences in federal contracting. The internet's most followed and highest earning creator is entering the race to buy TikTok. YouTube star Mr. Beast is part of a group of American investors assembled by tech entrepreneur Jesse Tinsley, vying to buy the social media platform before a possible ban takes effect. And champagne shipments dropped for a second straight year in 2024 amid a broader slowdown in luxury spending. According to data from Compte Champagne, shipments were down more than 9% to the lowest since 2001, excluding the pandemic. That's your Bloomberg brief. John.
Anne-Marie, who knows a lot about that. AMH, thank you. Up next on the programme, regulation in review.
Regulation is very important in the financial industry, but there's, I would call it outcome-oriented regulation that's effective and can be efficient. And then there's input-oriented regulation, which can be very ineffective and inefficient.
It's a major theme for the incoming administration. Under surveillance this morning, regulation in review.
Regulation is very important in the financial industry, but there's, I would call it outcome-oriented regulation that's effective and can be efficient. And then there's input-oriented regulation, which can be very ineffective and inefficient. And we've done some work on that to understand what's the difference and how can we engage with the administration to make sure we make the entire industry more productive.
We had a guest earlier on this morning who said, I don't like the word deregulation. Lisa, what did they say? It's sensible regulation.
Yeah. It's rational regulation. I love these words. So it's not deregulation.
These changes that a lot of people are looking forward to, and Lisa, they're expecting it to transform their business, that it will lead to better growth and ultimately better outcomes for the U.S. economy.
Well, and it's the deregulation, basically, and also the sense that people know what regulation they're following, that they're getting excited about. I think that the tax cuts also are something giving a tailwind. But how much of that's baked in? And that's, I think, what a lot of people are getting anxious about. It's all really great, but it's kind of in the price. And that's kind of what we're getting the sense of from investors.
We can have a deep dive on that conversation right now with the perfect guest, the Bridgewater Associates co-CIO, Karniol-Tambour. Karen, it's good to see you.
Great to be here.
The tone here is phenomenal, super upbeat. When we've spoken to American executives, they are fired up. Before we talk about 2025, I just want to reflect on 2024 with you. Double-digit returns for the firm. Can you walk us through which particular strategies were successful, where you found success in the market in the last 12 months?
Well, look, there's never one market that's the driver of success. We're obviously highly diversified, but I think it will really surprise you that our single best performer by far was in China, because the Chinese stock market was a disaster, right? China's going through a very painful deleveraging, not handling it particularly well. But the way we approached investing in China is that you don't want to rely on estimating that the policymakers will get it right. You sort of want to make a set of investments in China that can do well even if they stay in a pretty poor deleveraging. So the mix of holding kind of real assets in China, we buy commodities denominated in Chinese yuan so they can do well when the yuan depreciates. Holding the bonds in China actually helped us perform really well in China, even in a period of bad economics. So I'd call that out. And the second I'd call out is just currencies that I think were kind of boring, ignored for a long time, were a big winner for us.
Big move in the Chinese bond market. Chinese government bond yields have rolled over quite aggressively. Is this a position that you're keeping going into 2025, a theme that you want to keep playing?
We are. I mean, look, we're obviously looking carefully to say at what point can these bond yields not fall anymore, right? But everybody estimated this wrong when the United States, Europe, when we all went through our deleveragings. Everybody said, well, bond yields just can't go lower. There's no point in holding them anymore, and cut them way too soon. So I think that they're a nice diversifier to hold. They may not be a huge returner like 2024, but they're a pretty nice diversifier to hold. And the more Westerners step out of China, the more it's kind of like investing in Mars, right? Like every other market you hold, you have some of the same investors. So something happens, the same people pull in and out. Totally different investors are in China. They're marching by their own drumbeat. So we like the diversification.
I love that when everyone's leaning one way, you try to lean the other way. And that's been definitely the China bet. And you're sticking with it, this idea that China has more potential room to run than, say, some of the price to perfection markets in the United States. How much good news is baked in to the U.S. market?
I mean, look, I think it's a good but not amazing time to be taking risks in the market. If you kind of look at our measure of like how risk on, risk off do you want to be? If you did not look at price, you would say it's a pretty great time, right? Because you'd say growth is rolling. There's a lot of momentum there. Inflation is at least low enough that it's not a major problem for most central banks at the moment. And there's a desire by the central banks to keep easing. If that's all you heard, you'd say this is just a great time to be an investor. But then when you take into account what's already happened to risk premiums, how much is baked in, you've got to say, well, it can't be great. The hurdle for it to be great is just much higher. I mean, you look at the United States, and I'll give that as an example because it's obviously the most invested stock market in the world by a lot. Our number is something like you need, I don't know, 9.5%, 10% EPS growth to just kind of be on par with holding bonds. Now, that's not impossible. It could definitely happen. It just tells you that there's also room for disappointment, and you could have a pretty great year for the U.S. economy. You could have U.S. companies keep being really productive, keep returning money to shareholders, and it not be an amazing time to be an investor because it was already baked into the price.
So what's more price to perfection, stocks or U.S. government bonds?
Ooh, I mean, I'd say both are kind of priced for things working out well, but bonds need to be priced even more to perfection because if you think about things really going poorly, you're going to actually get a big bond rally, right? But if you think about an inflation problem, there's not a big inflation problem that's baked in at this point. And if you think about what it takes to buy a government bond today, how much extra yield are you getting relative to cash? It's not that much. And so it wouldn't take that much of a dramatic turn to get a little bit more of a yield curve there, a little bit more of carry for you to hold these bonds.
What do you think is behind the recent backup we've seen in bond yields?
Well, look, you clearly have an administration that wants to use fiscal policy that's not worried about running slightly bigger deficits. When you hear Trump's team, getting the tax cuts extended and hopefully larger is a very high priority. It's really, top of their list. And you're starting with a bond market that already has priced in, a very, very small carry. So I don't think it takes a lot. That said, there's been this kind of self-reinforcing nature to the bond market where every time the yield rises a little, that does its job to slow the economy a little, and then you get a little bit of a rally. So you've kind of been range-bound for a while, and there's a lot of reasons for that to stay.
With those high yields, we've had a much stronger dollar. A key difficulty, I think, for a lot of investors into 25 is to how to manage that FX risk. What are you suggesting people should do? What's your best advice?
Well, look, I think one of the big things structurally that happened in the market is a lot of people kind of forgot about currency management as an important issue. Because for many years, currencies didn't move as much as the underlying assets. So it didn't seem to matter. But in the last couple of years, you look at 2024, 2023, if you bought European stocks, Japanese stocks in America, it was dominated by the currency. That was a huge issue. So first of all, it's just even asking the question, saying what's neutral to me? And in my view, when you are taking foreign currency risk, that is uncompensated risk. So you should start out saying, I would be hedged unless I actually like that exposure. Now, I think the dollar probably has more room to run. You just have a stronger economy structurally. You have Trump policies that are very likely to be dollar bullish, right? You want to close the trade deficit. And so it's a good time for money to keep coming into the U.S. And if what you do is kind of close the trade deficit, but you don't tamper down anyone's desire to invest in the U.S. and the financial assets, you have to push the dollar up. My next favorite currency is probably the yen, but that means that pretty much almost any foreign investment you have, my view would be hedged back into the dollar today, because unless you have some view that you actually really like the euro or really like the UK pound, why are you holding this uncompensated risk? For people outside the United States, that actually means you could redenominate some of the assets into dollars, even if they're not U.S. assets, and maybe you don't need to hedge as much. You actually have more hedging abroad.
At what point does the strength of the dollar become destabilizing and actually really undermine other assets? And I say this at a time where the U.S. is still borrowing a lot. It's still sucking a lot of cash in. And you have a strong dollar that makes countries with external debt that much more expensive to pay back. Does it become a significant problem?
I think the first people who are going to say this is a problem and be able to maybe not do something about it are actually the Trump folks. I think at some point they're going to say, wait a minute, I don't know if this is aligned with where we really want to go. Now, I don't know what tools they'll use. I think it's kind of an open question of how much they'll be willing to really use tools versus more just, kind of in speech, hoping they talk the dollar down a little. But I think that they're likely to be the first people to say, wait a minute, has this gone too far?
Before we let you go back to the festivities and the discussions, one thing that I know you've been big on is gold. And this question of what's the inflation hedge that becomes most relevant at a time when it seems like we're in a new regime and inflation is going to be more prevalent, especially with a pro-growth policy. Are you still in that place?
Look, I like gold for two perspectives. I both like the inflation hedge, but I also kind of like the geopolitical hedge. If you look at who is buying gold, a lot of the gold buyers have really been those economies that feel most that the dollar is a political issue for them. And they don't have a lot of choices. Now, back on the dollar question, it's very hard to move the supply demand for dollars. So even if a lot of countries say, wait a minute, the dollar, that's politicized, there's so many buyers and sellers, but it's very easy to move the gold markets. And so a very small number of buyers saying, wait a minute, I need a geopolitical hedge. What can I hold? They don't have that many options. Gold is one of the only options where you can say, there's nothing politicized here. I literally have a physical bar that can sit here. And then it piles on, right? And so central banks do it. Suddenly it goes up in your currency, and then suddenly you get retail investors and all sorts of emerging markets thinking, I need gold. And it just doesn't take a lot to move such a small market because there's a limited amount of it in the world. So I like the geopolitical hedge along with the inflation hedge. And I think that in general, there's just not a ton of great inflation hedges around. It's a really good question for people to really ask in their portfolio, what do I believe is a real inflation hedge here? Which companies could really withstand inflation? What do I have here? These are tough questions, ones that I think are really worth grappling with.
It's a really important point, and we've certainly seen the central bank buying the gold over the last year.
Oh, yeah, ramping up to record levels. And they've just announced that they're planning to do more of it. And that's got a lead time as well. So to that point, it's one of the reasons why people are leading in to the gold bars that you can buy at what? Walmart? Costco. Is that what you did?
And other great retailers. Karen, it's good to see you. Thank you. Karen Karniol-Tambour there. Bridgewater Associates co-CIO. As we count you down to the opening bell, just a quick sneak peek of the calendar through the next few days and a week ahead. On Thursday, tomorrow, the President speaking remotely to Davos. Look out for that. Plus, we'll get another round of jobless claims. And then on Friday, a Bank of Japan rate decision. Another fantastic lineup of guests for you tomorrow morning. We'll be catching up with Ted Pick of Morgan Stanley and many more. From Davos, Switzerland, this is Bloomberg.